Good morning. Welcome back to docket number 24-1201. Attorney Wheel.
Thank you, Chairman. Tom Wheel for OCC. I just had a couple of administrative matters. I didn't mean to cut the company in line if they had administrative matters also, but I can, thank you.
It'd be fine if you go first, Attorney Wheel.
Thank you. My first is that we, embarrassingly enough, just noticed yesterday that on page 14 of the agenda, Doctors Hopkins and De Leon, who appeared already and were crossed by the company last week, are listed again on page 14. They were originally on page 6. And we didn't realize that they should be available again for that panel. We do have Brendan Larkin Connolly, who's also on that panel. He's going to be available. It's our understanding that that's the only witness the company has crossed for, and that everyone else has reserved the right for that panel. So we are hoping that the authority would excuse Doctors Hopkins and De Leon from appearing for a second time on the second panel on page 14.
Are there objections?
The company doesn't have any objection.
Thank you. Opinion? Okay. Okay, that request is granted.
Thank you. The only other matter I wanted to raise is that we have both Mr. DeFever, our witness on page 10 of the agenda, and Mr. Nelson, our witness on page 12 of the agenda, here in the building today. Both of those witnesses have flights home tomorrow morning, and that is potentially only problematic, I think, for Mr. Nelson on page 12. Based on the cross estimates and the sort of cadence of the hearing so far, it's not going to be a clincher to see whether we could get through the end of page 12 today. I did just ask the company if they would be willing to potentially switch the order to address our rate design panel before their rate design panel. So switch page, I think that'd be switching page 12 with page 11. My understanding is that they would accept that, but I'm not sure whether that would be acceptable to the authority.
Okay, we'll consider that. I will say, and I think we noticed yesterday that it is taking significantly longer to get through the authority's cross-examination of the current panel than we are anticipating. I want to say that we're probably 30% of the way through with our cross, if I understood our staff correctly. I think we appreciated the thoroughness of the responses, but I do want to just, advise the panelists that we're lagging a little bit behind what I think we were expecting. I would be happy to reverse the order of the rate design panels. I'm not sure if that gets us where we need to be based on the speed of the answers yesterday. So I guess what I'm saying is I will entertain that. I just don't know where that's going to resolve our issue.
Understood. And I did speak to Mr. Nelson about the potentially shifting to a later flight tomorrow. He said he's not sure what that looks like, but I'll speak to him again and see if that's possible.
Okay. I'll keep that in mind. Is there anything further, Attorney Wheel?
That's the last of our matters. Thank you.
Okay. Attorney Tisler, please.
I would just like to add to that conversation on the scheduling. The company also has noticed that we are approximately 4 hours behind where the company had anticipated we would be in the hearings by this point. And we realized that we may not finish environmental remediation on Wednesday afternoon. And we're inquiring as to what the authority's desired outcome on that is, if we would continue them on Thursday morning or, delay those until Monday. It just wasn't clear to me based off of the prior ruling if we are definitely skipping Thursday and Friday, or if we would roll into those dates for any panels that aren't concluded before PBR and ROE.
Thank you, Attorney Tisler. So my understanding was that the request is that we definitely do PBR tomorrow. Is that accurate?
No, I think their request was that we just switch the schedule to accommodate PBR so they would not be appearing on June 5th. Which is Thursday.
Okay, so they wanted ROE on Monday
Correct.
and PBR just not on the 5th.
That's correct.
Okay. Are there witnesses for your PBR panel that are traveling such that you need the answer now, or is this something, obviously tomorrow is the,
I would say yes, because we do have our PBR expert witnesses traveling from another state. So to the extent we can get clarity on when they would be expected to go, that would be very helpful. And to the extent we could get clarity as to when environmental remediation may be expected to go if they don't conclude tomorrow, that would also be helpful.
okay.
If it helps, I believe we could have our PBR panel appear on Friday,
Okay.
if necessary.
I think that we're probably heading toward that resolution where PBR would go on Friday, which would allow us to keep moving through the agenda in the order that it was largely requested. If that means that we conclude early on Thursday to avoid rolling into the PBR panel, we would do that. And if we're at the point on Friday where the only panel we do is PBR and then come back on Monday and do ROE. So I think that is fine. But I agree based on the speed of the way that the hearings are progressing, that we are likely to be here in some form or fashion Thursday and Friday. It's just a question of which panels. So I think right now my preference would be to keep rolling through the agenda in the order that it's specified, with the caveat that PBR would still switch places with ROE and go Friday, and ROE would go Monday for all witnesses.
Thank you.
Thank you. So let's just keep checking in about that. But all right, are there any further administrative matters?
Yes, the company has a few requests related to the read-ins. First, for read-in R, the company would request that we convert that to a late filed exhibit. I believe that would be LFE 54.
Okay, so the percentage of what was capitalized each year versus what was not.
Yes.
Yes, that would be late file exhibit 54. Okay.
And then this morning, the company is able to present read-ins P and read-ins Q.
Okay. Please proceed.
So in the company's response to OCC 151 RV01, we provided the budgeted labor broken out between O&M and capital for 2019 through year-to-date 2024. And the read-in request was to produce the same data for calendar year 2025. So for 2025, the O&M labor budgeted amount was 43.987 million, and the budgeted capital labor was 49.239 million, for a total labor budgeted of 93.226 million.
Thank you.
Also for read and Q, there was a question as to the 3% increase in the audit fees. each year, Deloitte will go through a similar compensation process as we do. Their employees will receive raises each year as Deloitte's costs go up. We will typically see an increase in the cost as well. In the public accounting industry in general as well, there's also continued changes and adjustments from their regulator around the auditing standards. And as there is, increases to the work that they have to perform, there can also be some increases. So the 3% is typically what we've seen. And to get the most representative level included in the rate year, that's the 3% amount referenced in our testimony.
Thank you. So I believe that just leaves read and H open according to my records. Attorney Tisler, anything further?
Not at this time. Thank you.
Thank you. All right, let's resume cross. Attorney Keenan, please.
Thank you, Chairman Gillette. Good morning. I just have a few follow-up questions from some of the responses I heard yesterday, and then I will continue on with the rest of the expenses. Yesterday, you noted that it is the company's position that directors are considered employees, not executives, correct?
That is correct. The executive title is for vice presidents and above. Executive and officer title is for vice presidents and above.
Okay, thank you. And is that definition of executive written anywhere in company policy, or is it being created for this proceeding?
It's not created for this proceeding. It's standard practice at our company. Vice presidents and above only are executives.
Thank you. And please confirm that the title director is used for management level personnel who oversee departments or functions.
Yes, that is true.
Does a director typically supervise other employees or teams?
Yes, a director usually has a team of employees reporting to him or her.
And do directors participate in budget development or financial reporting?
They would in terms of their own functional disciplines, yes.
And are directors involved in capital project oversight or strategic planning?
They would be for their specific areas of their function. They probably wouldn't be for the overall department, or that would be at the vice president or president level in the operations group. But for their specific areas, locations, geographies, they would be responsible for that.
Okay, thank you. And to whom do directors report? Typically a vice president?
They would report to a vice president or higher in some cases, depending on the organizational structure. But in the Yankee organization, they report to vice presidents.
Thank you. Does the company consider directors part of its management team for internal purposes, such as internal organizational charts?
Yes, we consider the directors and vice presidents above part of the company defined leadership team.
And is the incentive compensation for directors based on company-wide financial metrics such as earnings and rate-based growth?
They would, for directors, again, as we were discussing yesterday, there's the funding element that would have the earnings in it. Directors are rated on their individual performance goals in their departments.
And could that include company-wide financial metrics?
It would include department budgetary responsibilities at that level of the organization.
So it could include rate-based growth?
It would not it would not have rate-based growth as an individual goal for a director.
And so incentive compensation for directors would be affected by the overall company performance, much like or similar to the executive office?
It is. It's exactly the same in that the funding pool is based on the overall goals that we've discussed, earnings and dividend and operational goals. But the individual payout, that 0 to 200%, is based on their individual departmental metrics.
And if I could just briefly supplement with that, I think that's true of all employees, director and below, because as Mr. Lazar testified and is explaining, that's the initial determination of the level of the available financial resources to fund the variable compensation is what Mr. Lazar was talking about yesterday, and you were asking questions in the proxy. So there's the ability and the decision to fund the variable compensation at what level, which is informed by the financial health and well-being of the company and those specific goals. But then each individual and their payout is based on their job spec and function, which for all employees, really except for the CEO and the CFO, is more focused on budget management, cost control, executing on a capital plan, those sorts of initiatives, not the metrics that you're flagging. I'm not aware of a metric anywhere that targets rate-based growth. It's really the financial metrics that we talked about yesterday. Earnings per share or dividends per share and total shareholder return are evaluations to determine the financial ability to pay and to fund the pool. But then for every other employee, really beyond the CEO and the CFO, the quote-unquote financial metrics are those, like I said, which have a direct customer benefit as well. If we can control our costs and deliver excellent service to our customers more cheaply, that's a direct customer benefit.
Thank you. Is rate-based growth is that one way to increase earnings per share?
Rate-based growth, really, it depends on how that rate-based growth is being funded. Earnings per share is a function of our net income over the amount of outstanding shares. And to the extent we're not having timely recovery of the costs of that growth and rate base in any of our regulated jurisdictions, then that will not necessarily or at all indicate a growth in earnings per share. It's a much more nuanced and complicated discussion.
Has the company ever included directors in its executive headcount for internal HR, compensation benchmarking, or budget purposes?
No, the directors are a separate category.
In prior rate filings, has the company identified director compensation as part of executive compensation disclosures?
No.
Okay. Thank you. And lastly, we discussed briefly yesterday the long-term director stock. I would like to request the company provide the plan document for the long-term director stock as a late file exhibit.
Okay.
That will be late file exhibit 55.
Thank you. Okay, I'm going to start now with some questions regarding the computer expense. And I'd ask that you please pull up attachments 4 and 5 of the company's response to interrogatory OCC 242. And to confirm, attachment 4 of the company's response to interrogatory OCC 242 provides a complete listing of all amounts of computer services costs incurred by Yankee in the test year by invoice number, correct?
Just pulling that up. One moment, please. That's correct.
And attachment 5 provides the copies of the invoices for the amounts billed to Yankee in excess of $50,000, correct?
That's correct. The confidential attachment 5, and we also provided a redacted version.
Thank you. The goods and services related to these invoices generally support multiple Eversource entities, not just Yankee, correct?
That's correct.
Given that multiple entities utilize the services reflected in these invoices, the dollar amounts listed in attachment 4 of the company's response represent Yankee's allocated portion of each invoice, not the total invoice amount, correct?
That's correct.
I'd like to request a late file exhibit that reconciles the invoices provided in attachment 5 of the company's response to interrogatory OCC 242 to the amounts listed in attachment 4. And I specifically request the following. I'd like you to provide in an unlocked Excel worksheet with the formulas attached. If you could refer to attachment 5, I'd like a quantification of the total invoice amount, i.e. the full unallocated invoice total. And a description of the cost allocation methodology used to assign a portion of the total invoice amount to Yankee. And the underlying calculations demonstrating how the allocation methodology was applied to derive the specific dollar amount listed for Yankee in attachment 4.
I believe we can provide that, yes.
Thank you.
And just to clarify, is that for all 25 pages in attachment 4 for all line items?
Just the invoices.
The invoices? Is that clear in terms of what's being requested?
Yes.
Thank you.
It'll be for each invoice listed in attachment 5.
Leslie, file exhibit 56.
I now have specific questions regarding the invoices provided in attachment 5. And my first question is regarding invoice, and it's on page 10, invoice number 709305090. And this is an invoice for services provided by Accenture International Limited.
I'm sorry, can you please repeat the question and the reference?
Sure. So I'm on attachment 5 of the company's response to interrogatory OCC 242. And I'm going to be asking questions regarding the invoice on page 10, which is invoice number 709305090.
I'd just like to note that this is a confidential attachment.
I will not be asking anything. I'm only asking questions regarding the publicly disclosed information. And this is an invoice for services provided by Accenture International Limited and includes amounts for services performed in November 2022 and in December 2022, as well as services performed in the test year. Is there a reason why the amounts for December and November of 2022 services are included in the test year?
Subject to check, it would most likely be due to the timing of receiving the invoice itself. So we account for invoices according to GAAP. So when we receive those, we would record the expense on the company's books. So subject to check, that would most likely be why.
So the test year includes expenses that were not incurred in the test year?
So the way the company typically accounts for expenses is in accordance with GAAP, generally accepted accounting principles. Usually what the company will do is if we recognize an expense that we've incurred, we will book a unvouchered liability, or a UVL as we refer to it. So it's subject to check. Once again, I don't know for this specific cost here. Typically what the company does is it records an unvouchered liability in the month that it receives the services. So in this case, it would be either November or December of 22. And then in the following month, that unvouchered liability would reverse via an unvouchered reversal, so a UVR, for the equal and offsetting amount. And then when we receive the invoice, we would book the expense. And once again, subject to check on this specific invoice, due to the timing, it could have been unvouchered liability recorded in 2022, reversed in 23, and the expense booked in 23 when the invoice was received, offsetting to 0 in the test year. I don't know if that's the case for this specific invoice, but we can certainly follow up with a late file if you wanted to know. That's typically how we account for any expense. When the expense is incurred, we book an unvouchered liability. That reverses and the actual expense is recorded once we receive the invoice.
So this is a little bit confusing if we're trying to review the test year expenses, but there are other things being included that may be zeroed out, and how are we?
I think the witness has answered the question. He's willing to offer a late file exhibit to provide, more information to confirm what he said is subject to check. So we're happy to provide that.
Thank you. That would be great.
And just to provide a little more clarity as well, when in the data, what may occur is what Mr. Murray described, where we may have an estimated UVL, and then when the invoice is received, when that processes through our information, that's when all the invoice identifying information will be included in the detail. So I think to be responsive to the question, we likely included all the invoices that were included in that listing to make sure we provided everything. But as Mr. Murray described, based on the accrual accounting standards, that likely would have been UVL'd, and then when the invoice was received, reversed out.
Okay. I have a few more invoices which I have questions, and perhaps if it's the same situation, the company would be willing to provide an.
Combine those in a late file? Okay,
I'd appreciate that.
okay.
So I'll walk through them if that's okay.
And just to confirm, for late file 57, it would be at a minimum, Mr. Murray providing more information on page 10 of attachment 5 of QOCC 242. And we support the approach if there are more questions to consider combining those. Thank you.
Thank you very much. So my next question is regarding the invoice on page 13. And it's invoice number 233-17960. And it's an invoice for services performed by LTI Mindtree Limited. And again, it requests payment for a December 22 monthly invoice and vendor cost. And again, I have the question of why these amounts are included in the test year.
So once again, I'm speculating here, but this is a 2023 invoice. We received this in February of 2023. To the extent the company was not aware of the amount that it would be invoiced, then we would record this when we receive it as an expense in the company's books.
Okay, and in the late file exhibit, you'll confirm.
We'll provide the accounting for this one as well, yeah. So it could be if we were aware of these services, it could also be a UVL reversed, and then we book the actual and the invoices received.
Okay.
For purposes of this, we provided all invoices that we received, not the underlying accounting. So I don't have the answer for you, so.
Understood. And I have 3 more invoices, and I imagine that you're going to have to look into each one. So perhaps I'll provide to you the page number, the invoice number, and the service provider, and then you can include that in the late file exhibit.
Yep.
The next one is on page 41, and it's invoice number 233-01004. And again, it's an invoice performed for services performed by LTI Mindtree. The next one is on page 42, and it's invoice number 233-02805. Again, it's an invoice for services performed by LTI Mindtree. And lastly, it's the invoice on page 68, and it's invoice number 233-08746. And this invoice, it's dated December 30th, 2022, and it requests payment for a subscription.
Okay, just make sure I have those. That's page 10, 13, 41, 42, and 68.
Yes,
Okay, great, thank you.
thank you very much. I have a follow-up question. Where is the impact of the unvouchered liabilities reflected in attachment 4?
I would have to pull up the underlying accounting data to show you where.
Would it be possible to add that to late file exhibit 57 and
So to see the-
identification of where in attachment 4 is it the IVR? Is that?
To show you the UVLs,
That's it.
UVRs, and then
Yeah.
the invoice? Okay.
My next question is regarding attachment 2 to interrogatory OCC 242.
Sorry, I was just writing the last request. I apologize. What was the?
It's attachment 2 of the company's response to interrogatory OCC 242. And I'll give you some time to pull that up.
Okay, I'm there.
Referring to line 67, the vendor listed is GE Renewables Grid LLC. Would you agree that this vendor's name suggests an association with a renewable energy related services?
I wouldn't want to speculate to that. I don't know.
Okay, can you explain why costs related to this company are being sought for recovery in Yankee's gas distribution rate case?
I don't have that offhand. I can certainly provide that to you, though. I can look into the invoice.
Would it be possible to provide a copy of the contract with GE Renewable Grid LLC as a late file exhibit?
Yes, we can look into that and provide that.
So just to be clear, that was late file 58, and it's provide the explanation for the cost and copy the contract. Okay.
Thank you. And if you now turn to line 93 in that attachment, similar to the question regarding GE Renewable Grid LLC, could you explain why costs paid to North American Electric Reliability Corporation are being sought for recovery in this rate case?
Yeah, once again, without understanding the underlying details in the invoice, we can certainly look into that one as well, along with the GE Renewables to explain the specific charges related to this vendor.
Thank you. Could you also please provide a copy of the contract with North American Electric Reliability Corporation?
Can we add that to late file 58? Is that acceptable to Ms. Attorney Keenan?
That's great. Yes, thank you very much. And I now have a question regarding attachment 3. You don't need to pull it up. I'm not going to be asking any, I understand the entire response is confidential. I will not be asking any questions regarding what was provided in that response, except to ask whether the company has contracts in place for all of the computer services for the rate year.
I'm not our procurement expert, but I do believe we have, as part of our capital panel, our procurement team will be there present for that panel, who can speak to the actual contracts and whether we have contracts for each of the vendors that are listed.
Okay, thank you. Okay, I'm now turning to the corporate communications expense. And my first question is regarding invoices provided in attachment 2 of the company's response to interrogatory RRU 4. And it's my understanding that these are invoices greater than $1,000 for the test year, media relations, and other communications line item, correct?
Just going to need a minute to get to it.
Of course.
And just to clarify, that was attachment 1 to RRU 4?
It's attachment 2.
Attachment 2, thank you.
Okay, I have the attachment.
And to confirm, these are invoices greater than $1,000 for the test year media relations and other communications line item, correct?
And just to confirm, you said RRU 004, attachment 2?
Correct.
Okay, thank you.
Yes. Our response stated that the company was providing all vendor invoices greater than $1,000 in attachment 2.
Thank you. And I have questions regarding 2 of the invoices, and they're similar to my previous invoice questions.
So, yeah, we'll need to take a late file if we're going into that kind of detail.
Okay. So my first question is regarding the invoice on page 1. It's invoice number 1007087599. It's dated October 9th, 2023, and it's provided by Copyright Clearance Center. And it includes amounts for annual copyright license effective 12/31/2023 to 12/30/2024. And so if you want to provide in a late file exhibit, the reason why the costs for the copyright license, which is effective after the test year, are included in the test year.
Yes, we can provide a late file for that. You said, I didn't hear. Just said that we can provide the late file with the requested information.
And so that'll be late file exhibit 59.
59.
Thank you. And the other invoice, in which I have questions, is on page 3, and it's invoice number INV 0643223. And it's an invoice provided by Populo for licenses that begin on October 1st, 2023 and end September 30th, 2024.
Yes, I have the invoice. Yes.
And the question is there a reason why the company included this invoice in the test year, given that only a portion of it is for the test year period?
Yes, we can provide a late file with that explanation.
Thank you.
And just to provide some context as well from just the accounting background, when these types of invoices come in, typically the company's process would be to analyze the invoice and identify the period. And depending on when the invoice is paid, the goal in the accounting world is always to go by the accrual standards. And so for those invoices that identify periods in 2023, it could be that a portion of that invoice is included in expense, some of it is included in prepaid, depending on how the accounting went. I think in response to a lot of these questions, it was to provide the invoices, not necessarily all the detailed underlying accounting. So we can certainly do that in the late file, but just to provide some additional context on why you're potentially seeing some of these items.
Thank you very much. And my next question is, for each of the items listed in Schedule WPC 3.12, each of those line items, does the company have contracts in place for these services in the rate year?
I would have to defer to the procurement team on that to know if every single item is covered by a contract or not.
Okay, thank you. I'm now on to customer service expense. And I'm looking at both the schedule, WPC 3.13, and interrogatory response, RRU 5. And the company reports that it had 727,000 in AT&T charges related to call center data hosting and inbound, outbound usage. According to the company, it included these costs in the customer service expense schedule because the costs were recorded to customer accounts. Would you elaborate regarding what these costs are?
Yeah, so these costs are, as we had mentioned, they're related to the AT&T cost specific to the customer service center. So in our response, what we tried to explain is that the standard filing requirements in the state of Connecticut don't necessarily get into the granularity as far as what specific cost categories are required. So there's some subjectivity when the company prepares its standard filing requirements specific to those C3.X, I'll call it, schedules that we've, sort of utilized feedback from prior cases to expand within those sub-standard filing requirement categories. So customer services being one of them. And we've tried to account for it as such within the SFRs because our accounting is FERC account-based.
Mhm.
So when we prepare a rate case per the standard filing requirements, we have to take that FERC accounting and try to map it to schedules. So I think in this response, one thing was asked about why aren't these costs included in telecom? They certainly could be, but what we try to do is group them in the most helpful way to interveners. So for example, this specific cost they're asking about, these are specific to the customer service related function, although they are telecommunications costs. So that's why we've included them here in this schedule.
Thank you. And how does AT&T charge the company for these costs? Is there an underlying contract or?
I don't know the specifics of that contract, no. I think I would.
So the telecommunications charges are actually done in a system. And I don't have the acronym, sorry. In the system, what happens is all of the companies that we have any telephonic, any telecommunication contracts with that provide a service to us, what occurs is when a service begins, so when there's a new service, the IT department creates a work order, again, direct, common, causal, and they set it up in this system so that when the telecommunications system automatically feeds in that invoice, they have it linked to that work order. Then it automatically comes over into the power plan. Well, there's one step. It comes over through the procurement process for payment. And then when the accounting books and records bring that into the general ledger system, it's what I'll call system interfacing inflow.
But it's tied to a contract? The invoices are tied to a contract?
That is a procurement question I would ask them. The invoice itself is multiple lines, and every single one of those have a specific work order code or a multiple could. It's pretty sophisticated. I actually loved learning about it as a former accountant because it's pretty precise the way they do it in that source system.
Sounds like it. Thank you. My next questions are regarding ESCO capital funding. And my first question is regarding attachment 1 of the company's response to interrogatory RRU 130. I will also be referencing Schedule H 1.3, page 6.
If you would just give me 1 second to pull that up. I'm just grabbing my, no, I'm just grabbing my B schedule if you wouldn't mind 1 second.
And it was H 1.3.
Got that. Okay, thank you.
Would you please explain why the total equity of $932,342,966 for calendar year 2023 reported in attachment 1 of the company's response to interrogatory RRU 130 differs from the total proprietary capital of $597,722,343 for calendar year 2023 reported on line 55 on page 6 of Schedule H 1.3?
I'm sorry, what page? Line, you said line,
It's line 55 on page 6 of Schedule H 1.3.
thank you. Line 55 of page 6, got it. I can start before I get there. So there was activity at the end of the year. And I believe we tried to explain that in the response, but I'd be happy to go into it. At the end of the year, the company issued $400 million of long-term debt. The amount that was recorded within the FERC Form 60, that is based on the company's books and records closing, the accounting department performing all of their work. The FERC Form 60 is filed on May 1st. So in that FERC Form 60, it follows the GAAP accounting rules, GAAP accounting principles. The attachment that you were referring to is the calculation. So the calculation that the accounting organization uses to determine your rate of return for the shared service company begins with the line item that is your equity, but it is actually a month in arrears because when the accounting organization records that entry, it's usually the first week of the month-end close. So they are looking at the prior month. So then the equity isn't even closed yet. So they have to use a prior month amount. That is the standard process that Eversource has been using definitely for over a decade, and probably longer, I would say. Probably even a couple of decades because there's no look back. They have to close the books. They record it on workday 3-4, and so there's no information to give them that equity roll forward. So it is 1 month in arrears, if that makes sense.
And has Yankee filed ESCO's 2024 FERC Form 60 in this rate case?
We did, yes. We
Okay.
just recently did because we filed it with FERC May 1st. So
Okay.
it's been in the last month and I can't recall the exact one. I have it written down. Let me grab it.
Okay, that's fine. I will be able to locate it.
Okay.
Sticking with Schedule H 1.3, if you could turn to page 25. It appears that the 7-year term for the 70 million long-term debt expired on September 29th, 2024, subject to check. Can you explain why the calculated return on the expired long-term debt is included in the revenue requirement for the rate year?
Where's my phone? 1 second. May I take a read-in on that? I just want to confirm something. I'd appreciate it.
Sure.
We are up to read in S.
Thank you.
We're actually pulling up the page in the FERC Form 60 that was just filed this month. There's information there. I can read it in so we can move on.
Thank you.
Thank you.
Okay.
Yeah, I can just do that read-in now. I have it here.
Thanks. That's
And
great.
just to reference that FERC Form 60 before, that was RRU 378, Attachment 1, that provided the 2024 FERC Form 60. And in that same reference, specifically page 28 of the PDF, which is page 28 of 59 in the actual FERC Form 60, you'll see that there's a new issuance for the same $70 million issued. The term was from September 29th of 2024 through September 29th of 2031. And the total is still $499,500,000.
Thank you. My next question is regarding attachment 1 to the company's response to interrogatory OCC 462 and attachment 2 to the company's response to interrogatory RRU 23. Let me know when you're ready. Please.
Can you just repeat those? I believe I have OCC 462 Attachment 1 and RRU 023 Attachment 2.
Yes, thank you.
Okay. Thank you.
Okay.
Can you explain why the allocation percentages listed in the tab labeled rate M9C M01 and attachment 2 of interrogatory RRU 23 for Eversource Parent, the Rocky River Realty Company, Hopkinton LNG Corp., and Eversource Investment Service Company are not included in the 97.49% in column A labeled M9C in attachment 1 of the company's response to interrogatory OCC 462.
1 second. So this calculation includes the operating companies that are regulated, the ROE calculation that's developed by the corporate accounting organization, and that has been done again for as long as I can remember, at least 2 decades. They take regulated utility company business segments as well, so transmission business as well. And you'll see the transmission on line 2, 4, 6, and there's the sliver in line 8. So they take the regulated state and federal operating company ROEs as approved in the last rate case or through, the most recent decision settlement. And those are the amounts that are included in this analysis. The other companies are not regulated, so it wouldn't apply here.
And when you say this analysis and here, you're referring to the attachment 1 to the company's response and interrogatory OCC 462?
That's correct. Yes, your attachment 1 of OCC 462 has the operating companies that are regulated. That is correct.
Ms. Florida, are you saying that for calculating the ISCO capital funding, you are not including those unregulated entities, or you are not allocating any of the capital funding to those unregulated entities? Because the 97% seems to reflect the regulated entities, but you're not doing any allocation to those 4 companies that was mentioned earlier.
No, I'm so sorry. That's not what I was saying. The M9C allocator, that is what you were referring to in 22. There's all of the rate codes in many pages. It was like 50 pages that had every single, that's the one you were referring to, correct? For the M9C, the allocation code had those operating companies listed in there, correct? Mr. Suleiman?
Yes,
That-
they do, but
Correct.
I think I would like the company to refile OCC 242, which is 462, to include allocation of ISCO capital funding for those 4 entities.
Okay, I just want to make sure your theory that there is no capital funding that's allocated down, that's not how we do it. Every single operating company, every single subsidiary that is using shared service company assets is getting a portion of that cost based on the common causal and direct charging. Yes, but we can certainly do that.
Clarify for you guys to change that under 97% to 100% to include allocation factor that reflect those 4 entities that are not included in the calculation.
So you would like us to submit an LFE. We can
Yes.
have a narrative. 1 second. The issue is with our unregulated companies, there's no ROE. Do you see what I'm saying? The purpose of this OCC 462 is to determine a blended ROE for the shared service company to use. Let me take a step back, right? The shared service company is essentially a regulated company. It is a shared service company that is a shared service to all of our operating companies. So it is the construct of the shared service company is to ensure that all of the costs that are incurred are allocated to all of the companies for which it provides a service. Under the FERC Form 60 rules, it is accepted to perform a capital funding mechanism that has a justification for how it's developed across all of the shared service company that it is providing a shared service. Eversource uses all of the regulated operating companies that receive a service under the Eversource conglomerate in order to determine a blended rate. That blended rate is then what is used to allocate the capital funding to all of the operating companies.
I understand what you're doing, but what I'm trying to get to, ISCO provides services across the board to all operating company, whether they are regulated or unregulated.
Correct.
So when you allocating ISCO capital funding and you using 97% instead of 100% of the rate code, my request is for you to use the rate code that reflect 100% instead of 97 point something percent.
So let me separate the two. The 97% is the regulated companies used to determine the weighted average cost of capital that's approved. The rate code is used to charge all of the operating companies, subsidiaries, and transmission segments. They are not excluded. Does that make sense?
If you're using 97% to do a weighted average, in essence, based on my understanding, you're changing the rate codes to reattribute that 2.51% attributable to those other companies to the regulated companies. So my question for you is to use the MRC 9 code that include all those 4 other entities, regardless whether they have ROE or not.
And I see your struggle, and I'm trying to convey mine. We would have nothing for an approved ROE for those other operating companies. Some are non-regulated, regulated. Certain are unregulated because they're a joint venture. I'd have to look at the list. I don't have it in front of me.
I mean, when you calculate the ISCO capital funding, you're not just allocating the equity portion. You also allocating the debt portion of ISCO. Is that correct?
That is correct.
Okay, that's why I'm asking for the late file. Can you provide a late file that use the MRC 9, MRC 9, M9CR from, what was it, RIU 23?
The debt portion, though, is allocated as the M9C or the B08, the B10. That's separate. So there are two separate calculations. The first calculation, OCC 462, is used to develop a weighted average cost of capital. In the Yankee Gas rate case, that weighted average cost of capital, we change it once the decision comes out to the approved ROE. So
I'm still in that late file.
Okay.
That use the,
I mean, I'm going to have to put zeros if that's okay.
that's fine.
Okay.
Can I just confirm that the witness understands what's being requested and we can provide? Okay.
I think, Mr. Bakari, the concern that we have is it wouldn't produce a methodologically sound basis for what the purpose of the schedule that Ms. Bruder was speaking to is intended to do, which is that the OCC 462 attachment 1, the schedule that you're pointing out doesn't include those unregulateds as part of that M9C allocator. The purpose of that schedule is to determine a weighted average return on equity that is then charged out by the service company. It's not the actual charging out of cost. So if we were to include, an ROE of 0, we'd be artificially lowering the service company's required return on equity. We're still allocating out the cost, though, to all the entities, including those unregulated entities that are receiving services from the service company. But we would be creating now a mismatch if we did the math exercise you're asking us to by developing an ROE that is inclusive of unregulated entities that don't have a regulated return on equity. So that's why we have in this or OCC 462 attachment 1. That's the purpose of that spreadsheet and that calculation.
And to add to that, that 9.62, which is the sole purpose of this calculation, it's just to develop that 9.62, that's replaced. The only amount that we seek recovery from customers is the actual amount that's approved by PURA in the rate case proceeding. So in our LFE 001 final decision, we will update the capital funding to only include the actual amount that comes out of this rate case. Right now, we have 10.3 and there's a holder, but otherwise it would be 9.62. Do you see the difference?
I'm glad you actually mentioned that. When you calculate for the rate year, do you base the amount that you requested for the rate year based on the pro rata percentage from the test year?
We base it on the requested return on equity that would be approved by PURA, which will be updated. In other words, so for accounting purposes, we reflect the return on equity that's calculated here. So the actual accounting would reflect that, but for purposes of rate making, we reflect.
No, I'm saying for the different rate codes that we use, subject to check, the company apply a pro rata of those rate code from the test year to determine the level of amount that being requested for the rate year. Is that correct? I don't have the particular response in front of me, but I believe that's what the company did.
Yeah, I think I may be able to help clarify some things just with regards to the allocation of the costs themselves and to show the math that they are allocated amongst all of the operating companies under the Eversource. We filed a response RRU 130 attachment 1 that provides the calculation of the ESCO capital funding. In there, we show the Yankee Gas allocation of those charges utilizing the M9C rate code of 7.24%. That 7.24% is what I believe the authority was referencing in RRU 023, tab rate M9C M01, specifically Excel line 21, Yankee Gas Services Company, which is 7.24%. So that confirms what the company is using to actually charge out the service company capital funding is the M9C rate code inclusive of those 4 companies that were referenced earlier. I believe Eversource Energy Parent, Rocky River Realty Company, Hopkinton, and Eversource Investment Service Company. Let me know if that helps at all, or I can repeat anything.
Yeah. Going back to RRU 131 that you just referenced, are you showing the calculation for the rate year or for the test year in that response?
In RRU 130 attachment 1. Sorry, I just lost it. I believe it does provide all years, though. I believe it has historical years and the test year as well. But I was specifically referring to the test year, the 7.24%. I'm just pulling it up one more.
If you look at the 130 and you look at the rate year, subject to check, how do you determine the M9C code of 7.69 for the rate year? Oh, sorry.
Yes, just give me 1 second to pull it up. Okay. If you go to RRU 023, attachment to page 31, do you have that up? You're much faster than me. These are the rate codes developed on at least an annual basis, as I described yesterday. If you look at this one, right below where it says rate code M9C, it's identified also as M01, and we just use both terminologies for the same rate code. This one is based on the Eversource Service Company distributed labor. So it's all of your 4,007 Eversource Service Company employee labor that is charged across all of the work orders that come through Eversource Energy Service Company. So you'll see the labor total charged labor. On the first line item, you have CLMP distribution at 90,966,000 and so forth, for a total of 454 million of ESCO labor.
This is 70.
I don't have the 2024 or 2025 in front of me. I know we have an LFE coming through, but this is likely based on the 2024. We will take a read-in because I have the accounting team with me, knowing we were going to get these questions today. So we'll take a read-in.
Is that?
Will we be able to explain how the company determined the 7.69 rate year M9C allocated through a reading, or do you want a late file for that?
Mr. Bakar, I think you're correct. A late file that would probably be the most efficient vehicle for us to put that information in. The backup for the 769% rate year M9C allocator.
Yes. Okay, thank you.
And we've determined we don't need the previous late file in which we requested the recalculation, that we requested the company refile OCC 462 attachment 1 by recalculating the 97.49%. We no longer require that. So this new late file will become late file 60. Correct. Thank you.
Go ahead.
My next question is regarding attachment to the company's response to interrogatory OCC 462.
Which attachment again? Attachment?
It's attachment 2. And I have a question regarding footnote D.
Okay, let me confer. Can we take a read-in for that one? Superscript footnote. Thank you.
Yeah, my, maybe I should, so in footnote D, the company states as reallocating the ESCO capital cost for the rate year to the applicable rate codes based on each rate code's respective percentage in the test year, correct?
We'll take the read-in if we can.
I wanted to request a late filed exhibit. I ask that the company refile attachment 2 of its response to interrogatory OCC 462 using Yankee's current ROE of 9.3% instead of the corporate-wide average of 9.62%.
See where you're going. Thank you.
And additionally, I would like the company to apply an ROR of 7.24% for Yankee rather than the weighted factor of 7.43% for ROR rate code M9C.
Will be late file exhibit 61.
Thank you. My next question is regarding attachment 1 of the company's response to interrogatory RRU 376.
Okay, I'm there.
In attachment 1, is Yankee using the gross revenue conversion factor in line 17 to include the income taxes in amounts reported in line 18?
Could you repeat the question, Ms. Keenan? I think you asked if we include the gross, please repeat the question.
Sure. Is Yankee using the gross revenue conversion factor in line 17 to include the income taxes in amounts reported in line 18?
So yes, your line 18 includes the tax component for your line 15 return. So the line 17 includes the your tax gross conversion factor. That's correct. If you're asking me the difference between what you're seeing on line 15 and 17 is the tax gross up, saying it differently.
And the difference between lines 15 and 18 represent income taxes?
That is correct for shared service company.
Thank you. In which FERC accounts are the income taxes recorded?
So at the service company, they are recorded in accounts 930. I don't know the last 3 numbers. There's 6 numbers. I don't know those off the top of my head. If you'd like for me to pull those up, I can in the FERC Form 60, or we could do a read-in and I can pull that on break. But they are recorded in the, there's so taxes are recorded in FERC account 409-410. The tax gross up piece that relates to the return at the shared service company are recorded in a 930 account in our FERC Form 60. It's a FERC Form 60 presentation in order for you to provide within your FERC Form 60 your fallout return in total. So it's a FERC presentation. I'm saying this because if you pull your FERC Form 60 detail, you're going to see that, Mr. Suleiman.
Okay.
But I will take a read-in to get you the line item in the FERC Form 60 so we can talk through it.
No, we're fine with it.
We're fine. No need for the read-in. Okay, and back to attachment 1. In that attachment, the ROE rate represents ESCO's net income, and ESCO's net income is already grossed up for income taxes, correct?
What line are you on, Ms. Keenan?
Line 15.
Line 15. So I apologize if I wasn't clear. Your annualized rate of return that's included on line 15 would be the shared service company net income before the tax gross up piece. So I hope that answers your question. Your line 15 is your earnings. Your line 17 is the tax gross up. And then your line 18 is in order for you to be able to recover from all of your operating companies, your earnings plus the tax gross up because of what we would be required to pay at the shared service company. Both state and federal, by the way, the blended, for our obligation at the service company for state and federal taxes.
Thank you. So since the income tax related to ESCO's net income, i.e. the ROE portion, are already included in ESCO's capital funding calculation, why did the company allocate the service company tax expense to be billed to affiliates to Yankee in the O&M residual expense?
I'd have to look at my detail in the O&M residual expense. Do you want me to do that now? We can pull it up now. I do recall there being a tax component. I just have to look at it because that's
That's
a
fine.
different schedule. Do you want us to do that now? Okay,
Please.
so just give us a moment.
And just so you know, it's referred to as service company tax expense to be billed to affiliates in attachment 2 of the company's response to interrogatory RRU 370. And then NUSCO Inc. tax billed in attachment 1 of the response to interrogatory RRU 7. So it's referred to 2 different ways. Questions. I have no question. I have no question. I'm referring to this.
Exactly. At the come up the.
Okay.
Thank you for that. Appreciate that. You do see the 930 TXA within the O&M residual FERC account 930 TXA. That piece is the gross up it's the tax piece associated with the return. The return is charged down in 2 steps. The first step is the actual return before gross up. That goes to so from ESCO, it gets charged down to Yankee Gas. So that comes down just return, no tax gross up. Within that entry, there's a second component. That is the tax gross up piece. That comes in separately, and it's recorded at all the operating companies as 930 TXA. The 930 TXA is the tax gross up. So there's no double recording. It's recorded in 2 steps so that the company can easily see that in the organization, and we can easily pull that into the FERC Form 60 reporting.
Yes, but one more clarifying question. The line reference earlier, where the company is using the gross revenue conversion factor to gross up the equity portion. Could you explain if the gross up amount is included in the total amount that's been allocated to the affiliated company?
I'm going to need to consult with our tax experts, if that's okay. The tax gross up piece and how it's flowed through the accounting organization is, again, it's a 2-step process. We record it in certain accounts because we want to be able to identify it for purposes like this. The 930 TXA is an area that my tax team and the accounting organization is going to have to help me with. So if I could take a late file on that, that is the amount that's sitting. So I think the question is, please explain. I'll let you ask the question, but let me refer back to, I think I know what you would like to see. In our O&M residual schedule with all of the leftover that's not in any of the SFRs, you're asking why is there a 930 TXA there? And in the C 3.14, we have our shared service company return that's expensed down to, or allocated down to Yankee Gas. So we will provide you an explanation on those 2 components, if that's okay.
That's fine. I just want to confirm that in your calculation of the ISCO capital funding, that the company is grossing up the equity return to reflect the income tax implication on the equity, and that the total amount that's being redistributed to the operating company included the gross up for income taxes. So if your explanation or your late file response can confirm or not confirm what is in your application, that's what we're trying to get.
Understood. We will provide to you what is in the rate case request, both in the test year and the rate year. Thank you.
Thank you.
Okay, so that being provided as a read-in, Ms. Peruta, or?
I think it's a late file, right, Ms. Peruta? Late file? Okay.
Okay, so that'll be late file exhibit 62, I believe.
Okay, and I have another request for a late filed exhibit. I would like the company to provide an unlocked Excel worksheet with the formulas intact that details how the company derived the following 3 amounts provided in attachment 1 of its response to interrogatory RRU 376. The first of the 3 amounts is the 2023 long-term debt interest of $3,470,369. The second amount is the annual short-term debt expense of $10,367,219 for 2023 on line 34. And the $6,747 for the rate year, also on line 34.
That'll be in a separate late file, right? Late file.
Okay, you want to ask your questions?
Yes, yes. I have slight follow-up on some of the testimony from yesterday. I believe you testified that the company has filed 2024 they also filed the 2024 for Form 2 for Yankee. And which particular response is this? Because I don't have it.
We have filed FERC Form 2 for fiscal year 2024. I'm not sure off the top of my head if that's an attachment already in the file, but if it's not, we'd be happy to provide it.
Chair, can we have that as a reading?
Do you want the physical document filed as a PDF? We can do that as a late file, or if you want to read and we can read a number in if there's.
Oh, yeah, it has not been filed into the record of this proceeding. As a company filing to the record of this proceeding, or
Okay. I understand. He wants us to identify if there's an actual data response. Understood.
Correct,
Okay.
please. So that would be read in T. And I'm sorry, the FERC number was
for Form 2.
FERC Form 2.
Could you please turn to Exhibit YGS Revenue Requirement 2, Schedule H 1.0, please?
I'm there.
Can you turn to page 170?
I'm there.
Could you confirm if the amount in column D, line 5, represents ISCO total O&M allocated to Yankee for 2023?
Confirmed. That is the 2023. Can you hear me okay?
And those amounts are included in Yankee's O&M expense, is that correct?
That is correct. That the 98.8 million is the amount for Yankee Gas that was charged down, allocated down, direct, common causal from the service company.
And component of that $98 million are reflected in the SFR schedule for 2023 as part of the test year amount, is that correct as well?
That is correct. That the costs that are included in this FERC Form 2 are costs that are embedded within our schedule SFRs. That is correct, that are ESCO related. But there is a difference. Please keep going.
If you turn to page 171 of the same exhibit. The second column labeled accounts. Could you explain if those are ISCO accounts or those are Yankees accounts?
You are on page
171.
171. Okay. Okay. And you are asking if these are
The account,
ESCO accounts or
Yankees account.
you mean like the actual oh, I see. You're looking at the account.
Yes.
Okay, got you. Those are, 1 second, let me just confirm. My FERC form expert. Okay, thank you for your patience. These are roll-up FERC accounts, or call them the accounts at a grouped level for the costs as they are reflected at Yankee Gas Services Company that are flowing from shared service company. So you'll see, for example, I was questioning the same thing to our accounting experts. You'll see, for example, the first line says FERC account 401. The question would be, where are my 920s in here? And she confirmed that's the roll-up. The 401s is your O&M accounts.
When you say roll-up account, those account at the group's level or the service company level? Is that what's the?
So this is at the group level at Yankee Gas, at the Yankee Gas level. And I do have our witness, Mr. O'Brien, who's also here. But that is at the Yankee Gas level. For presentation purposes, I will add, it is a presentation in the FERC form too, I would expect. And Mr. O'Brien, we can, subject to check if we can confirm this is the appropriate, go ahead.
Yeah, so on page 38 of attachment YGS RevRec to H 1.0, you'll see the operating expenses line in line 4 there. And next to that description in parentheses is 401. I think that's the roll-up that Ms. Bruda is referring to. And it's of the document, it's page 114, the statement of income.
The amount level for account 107, is that amount being reported in Yankees 107 account? The 2,540,321?
.107 is QUIP at Yankee Gas. Go ahead.
That's construction work in progress, is that correct?
I'm sorry, yes, that is construction work in progress at Yankee Gas.
And that 2,540,321 is coming from ISCO, that's correct?
It's scattered all over the place, so I just want to make sure I know where what page are you on? I see it in a couple of places.
I'm still on page 171.
Okay, I moved on to 172, I'm so sorry. And you are on which section?
The benefit section, the second item there is
Yep.
account 107, 2,540,321.
That's correct, yes.
My question is that QUIP at ISCO being allocated to Yankee? Or that's Yankee's QUIP?
So this is shared service company employee. I mentioned yesterday when we were walking through that process, a shared service company employee can charge a work order. I'll try to make it click, Madam Chair, quick. When a shared service company employee charges a capital work order, it gets, because they're working on either a gas project, whatever, it gets charged down to Yankee Gas. That gets recorded in QUIP. In addition to that, a shared service company employee has benefits. That's loaded. So, and I don't know if I mentioned this part, but I'll mention it today. When a shared service company charges any work order, there's an attached loader for their benefits. This is the benefit associated with the employees that charged QUIP. So it's classified in the benefits section in the FERC Form 2.
So your testimony is that an employee working on a capital project charges their time to construction work in progress that's allocated to Yankee as O&M expense.
I missed that last part. I'm sorry, Mr. Suleiman.
I mean, I've confirmed earlier that the total of $98 million is allocated to Yankee as O&M expense in the SFR schedule. And a component of that is account 107.
So the 107 is part of the total 98 million.
Yeah.
The 98 million is all the costs charged down. So it's treated as a cost because it's a shared service company in this case. It's a shared service company employee that is providing a service to Yankee Gas. So the shared service company is pushing that charge down to Yankee Gas through the direct work order. So the 98 million represents all costs at the shared service company that is being direct, common, causal allocated down to Yankee Gas. So that 98 million is not all costs, to your point. There is a to clarify, the 98 million is not all O&M at Yankee Gas.
For account 107 and account 108 that are listed on page 171 through 174, would the company be able to provide the authority which SFR those two costs related to those accounts are reported on Yankee's book?
Are you requesting could you just repeat your request?
I'm looking at the entirety of the total amount that the company allocated to Yankee, the $98 million we discussed earlier. But some of them are reported in account 107, and some of them are reported in account 106 as well as 108. My question for the company is to provide, at least for those three accounts, 106, 107, and 108, where in Yankees SFR those amounts are reported.
In the Yankee Gas, we can point to where on the record those are recorded. We can do that. Yes.
Chairman, that would be another late file, number 64, for the company to identify where in the SFR, the amount reported on Schedule H 1.0, page 170, 171 through 174, where they are reported in Yankee SFR schedules.
Correct, late file exhibit 64.
That's 174, 171 through 174. Account 106 through 108. Schedule H 1.0 is. I just have one more question. Yesterday you referenced the management audit report and you indicated that the auditors identify 4 factors that Yankee used to indirect allocate costs. Could you repeat what those factors are again? Because just
If you give me 1 second, I'll bring those up. Okay. The 4 items were, the first one being cost distribution procedures were straightforward and not necessarily complex. The second one, procedures distributed a majority of the service company's costs using direct and attributable methods. The third, the process did not distribute significant costs between dissimilar regulated and non-regulated business segments using unattributable allocation methodologies. And the fourth, the auditors noted that they based their measurement of subsidiaries sized on an average of customers, revenue, operating income, gross plant, and net plant that they picked up from the Eversource financial data that was disclosed publicly.
for the last part, subject to check, do you know if those factors for indirect allocation are the same factor that for those entities that use mass formula? Do you know if those are the same factor that they use for calculating the mass formula? Or the component of the mass formula?
Am I aware of?
I'm asking if you're aware that for the last part of your question, listing all the factors that the company used for indirect allocation, if those components are also used in mass formula calculations.
Okay, so I'm not familiar with the mass formula rate. I know that that is a rate that is used in the utility industry. And I know that that's a default rate in the utility industry in cases where they cannot segmentize their business the way Eversource does in order to produce this 11 methodology framework. Based on my understanding, the mass formula rate components, those components are, and subject to check, those 3 components in the mass formula rate are components that are used within our 11 methodologies.
All right, thank you. That's all I have.
Okay, I have the mass formula rate definition. It is average of subsidiary revenues, plant, and payroll, so labor.
Oh. Did the external auditors or the management auditor identify those as some of the factors that the company use for indirect allocation?
I would have to confirm that with the organization that worked with the management audit team.
That's fine. Chair, can we get a reading for the company to confirm if the mass formula factor were identified by the management auditors as some of the factors that the company used for indirect allocation?
Yes, and that confirmation of whether the management auditor has cited that would be read in U.
That's element. Indirect allocation.
I have a few questions regarding healthcare benefits. In the company's response to interrogatory RRU 182, the company states its year-over-year observed per employee trend for medical costs from August 2022 to July 2023 versus August 2023 to July 2024 was 3.9%. Given this actual observed trend, why is the company using a 7% projection rate for the rate year?
Sorry, which question was that? Which,
Interact, it's the company's response to interrogatory RRU 182.
and could you just repeat your question on that again?
So in that response, the company states its year-over-year observed per employee trend for medical costs from August 2022 to July 2023 versus August 2023 to July 2024 was 3.9%. And I'm asking, given this actual observed trend, why is the company using a 7% projection rate for the rate year?
Well, simply put, we looked at in part B was it the 7% is an estimate, but it is based on the most recent underwriting calculations. And based on estimated increases going forward.
Okay. In its response to interrogatory OCC 228, the company states that it included the medical opt-out expense on line 17 of page 1 of Schedule WPC 3.15. Can you provide the amount of the opt-out expense reflected in both the test year and the rate year and identify where the amount is on page 2 of Schedule WPC 3.15? Do you have that amount now?
I don't have it at the moment.
Okay.
Yeah, I think we could provide that as part of a late file. We do have that data. It would just be getting the calculations for you. So we could provide that in a late file.
Okay, that will be late file exhibit 65.
And that's the calculation of the medical opt-out expense and where it's included in the calculation for both the test year and the rate year. In the company's response to interrogatory RRU 195, the company states that Eversource pays $500 per medical opt-out employee, but nothing for dental and vision. To whom does Eversource provide that payment?
The payment would go to the employee who opted out.
What is the per employee healthcare benefit expense for Yankee FTEs? And what is the per employee healthcare benefit expense for ESCO FTEs?
When we look at the reduction of our costs, we see it as 22,804 per employee,
Is that Yankee per Yankee employee?
be per all employees.
Can you break it down between Yankee and ESCO FTEs?
Okay, so do we need the answer to that question as a read-in or a lay file?
That probably a late file is best.
So can the late file include the per employee healthcare benefit expense for Yankee FTEs and the per employee expense for ESCO FTEs, as well as how many Yankee FTEs and how many ESCO FTEs are those per employee amounts based?
Got it.
Okay, that's late file exhibit 66.
Thank you. And with the previous late file regarding the medical opt-out expense, that's going to include the calculation of the medical opt-out expense for Yankee FTEs and for
You would break
ESCO
that, yep,
FTEs. And it'll include the amount of the expense and the number of Yankee FTEs, the number of ESCO FTEs the company is including in the calculation.
Makes sense. Got it.
Great, thank you. I now have some questions regarding pension and 401k. And I'm looking at late filed exhibit 1, SP01, schedule WPC 3.15, page 1, as well as schedule WPC 3.51, page 1 in the original application that was filed by the company. Can the company explain, one, why the rate year pension expense increased from a credit of 4.126 million up to a credit of 2.041 million?
Yes, so I think it'll be helpful to actually explain the both changes that happened because they're both under the same reasoning. So when we updated late file 1, supplement 1, which is the company's cost of service, there were two main factors. So first, in the original filing, we had included in there costs associated with the company's K Vantage plan, which was part of the line item labeled supplemental retirement plan 401k. And in addition, the pension line only included the traditional defined benefit pension costs. In our supplement 1, late file 1, supplement 1, we reflected a couple of changes. One was to remove the costs associated with the K Vantage program because that no longer exists effective 1/1/25. And the second change was to supplemental 401k was to include an additional cost for those employees that were eligible for an additional 3% 401k matching from 3% to 6%. That's why essentially in that line, you see a little bit of a flatter change because we have a reduction for the removal of the K Vantage costs and an addition of the additional 3% of 401k matching. For the pension line specifically, the last change was to reflect the additional costs related to the cash balance pension plan that was spoke to by our benefits panel yesterday. So overall, I believe it was a net increase of approximately $700,000 amongst the three changes.
And what are the three, the change to the pension expense, the change to the 401k expense, and what was the third?
So there's two to the 401k expense. There's a reduction to reflect the removal of K Vantage and the costs associated with that program that expired or no longer exists going forward effective 12/31/24. And then the addition of 3% additional 401k match. So those are both reflected in the supplemental retirement plan 401k line.
Okay.
Those were two items. And then the pension for the cash balance pension plan change. So those are the three I was referring to.
Okay, thank you. And the cash balance pension plan is primarily a 401k matching program, correct?
No, that's not the case. Mr. Lazar, I think can speak better to it, but
No, it's a replacement for the K-Vantage plan, and it is a contribution based on age and service time.
Did the company have its actuary reproduce its report that support the inclusion of the effect of the cash balance pension plan for both the pension expense and the 401k?
subject to check, I do believe we did get an updated report.
Do you know if you filed those in the record?
Jack, I believe they were, but we need to just check where they were exactly.
Okay, could we have a read-in regarding where in the record the updated reports are located?
Be read in V.
Has the company provided in the record the calculation of the average cost of the 401k expense per Yankee employee and per ESCO employee?
Not that I'm aware of.
Would you please provide that as a late file exhibit? I'd like the late file exhibit to show the calculation of the average cost per employee of the 401k expense for all Yankee FTEs and then for all ESCO FTEs. And if you could provide the number of employees that are used in that calculation.
It's late file exhibit 67.
Thank you. I'm moving on to the facilities maintenance expense, and I'm looking at attachment 1 to the company's response to RRU 54-SP01. And in this attachment, the company provided a listing of outside vendors and page number references to the associated contracts. And my first question is, what does the NA in column E mean? Does it mean that there's no contract associated with the vendor, or that the company did not provide the contract because the contract was less than $10,000 in expenses?
Sorry, I'm just pulling it up. Thank you. I'll have to double check on that. I do believe some of these may not have contracts and others do fall under the threshold, but I'll double check.
Okay, thank you.
Is that a late file or a read-in?
Let's make it a late file because I think the question, the follow-up question is going to be if there's a difference between what NA means for each line, I think we're going to need to know what it means for each line, please. So let's make that
Okay.
late file exhibit 68.
It's a late file 68. Thank you.
And my next question is, and I'm not sure if this panel can answer it, or perhaps they could provide the response in late file exhibit 68, but does the company have contracts in place in the rate year for the services provided by the outside vendors listed in attachment 1 or other vendors?
Yeah, we can add that to the late file 68.
Thank you.
That would require us to go through every contract. You're asking to go through every contract to identify whether or not that contract is applicable to the period covered by the rate year?
I'm just trying to confirm if the company has contracts in place for the rate year for all of the services that fall under the facilities maintenance expense.
Okay,
Thank you.
can add that.
And I'm moving on to field operations, and I have a similar question, except a different interrogatory. So looking at attachment 1 to the company's response to interrogatory RRU-53-SP01. And my first question, this is probably going to have to be another late file exhibit. My first question is regarding what the NA in column E means. And then my second,
Yeah, I was able to actually confirm. So NA for all of these means there's no contract associated with that particular line item.
okay. And that's for both the facilities operations
That's correct.
expense and for the field operations.
That's correct. We could still utilize late file 68 though to respond to your other portion of the question.
Thank you. And can I add to late file exhibit 68, whether the company has contracts in place in the rate year for the expenses provided in the field operations expense schedule?
Okay, so late file exhibit 68 will apply to both the field operations and the facilities maintenance.
Thank you. My next question is regarding the human resources, education, and training expense. The company states in its response to interrogatory RRU 357 that it does not track travel or conference expenses by specific business purpose, attendee information, and how the expense directly benefits ratepayers, but did identify $77,853 in travel expenses in the test year pro forma. Can you identify the schedule and line item in which the travel expense is located?
So that was identified by the use of a cost element. So that could be in throughout the cost of service schedules. So we would have to go back and try to see where that cost element landed in the cost of service schedules.
Do you know if the travel's related to training, or you don't know?
I don't believe we would have that level of detail available. The cost element was just based on travel expense. So I don't think it's going to tell us, if it was related to a training matter or not.
Okay. And do you know generally what the travel expense will be, is sprinkled throughout the C schedules, correct?
Correct.
Are there specific C schedules that travel
I
would
couldn't-
appear?
I couldn't speculate on that, if there was certain C schedules that had more travel than others.
Thank you. Okay, I have a couple questions regarding the insurance expense. In its response to interrogatory RRU 281, the company states that an ERISA class action lawsuit in 2020, which was settled in 2023, resulted in premium increases, specifically the 94% increase between 2019 and the rate year, and the 15% between 2024 and the rate year. What was the issue being litigated in the ERISA class action lawsuit, and how does it relate to Yankee?
We can provide that in a late file exhibit.
Okay. That will be lay file exhibit 69.
Thank you. And this is my last question regarding the insurance expense. Can you point to where in the record the documentation supporting the escalation factors for each insurance expense line item is located? For example, where in the record is the documentation supporting the 22% increase in general liability insurance?
So we originally filed it in our pre-filed testimony. Which was, in November of 2024. Later in the year for general liability, I'll call it the policy period, because we hadn't received it in time for filing. We did receive discovery, and we were notified that the 2024 policy had come down. So that is an example where the insurance premiums came down after the rate case application filing. So what is on the record, as you indicated, is in our pre-filed testimony, the discovery. We supported it by stating that those were the percentages that were provided by the insurance broker's forecast plus their experience in the insurance world. There is one confidential email, if I could just, 1 second. It is confidential, so
I think I'm familiar with that, with the email you're referring to. I guess I understand that you provided information in pre-filed testimony. What I'm actually looking for is documentation. So for each one, general liability, 22%, workers' comp, 10% increase, property loss, 24% increase, privacy protection, 10% increase, D&O had no change, fiduciary, 15% increase, crime, 5% increase. So I'm looking for documentation to support each one of the increase for each one of those insurance
right. So
items.
we did have discovery in RU 197 that asked for declaration pages,
Which you didn't have, I
which
understand.
the insurance department did not have. We also received discovery in RU 281, where our insurance team, the director of insurance plus the full team who has a very close relationship with the insurance broker, I'll call it industry. They're the ones that procure the insurance on an annual basis. They have the relationships, they understand the business. They are the experts of Eversource, utilizing the insurance brokers that Eversource works with.
Okay.
So that is RU 281. That is
Okay.
the best information we could provide in terms of the experts that the company uses internally and externally.
Okay, thank you.
Okay, we're going to take our lunch break. We will resume cross with this panel at 1 p.m., please.
Yeah.
Yeah. We do. We do.
Please be seated. Welcome back. Is there anything from the company before we resume? Attorney Tisler.
Yes, thank you, Chairman Gillette. The company over the lunch break has taken into consideration the scheduling and the progress we're making on the testimony for revenue requirements panel. And in light of that consideration, the company is willing to waive its cross of the OCC's witnesses, DeFever and Nelson, so that those cross-examinations by the company would no longer be necessary.
Okay, thank you. Um,
I also have another matter. Based off of the cross-examination before the lunch break, we noticed that there were many questions relating to procurement. And in light of that, we have a witness that we would like to join the revenue requirements panel from the procurement department.
okay.
He is just arriving now. It's Mr. Craig Dykeman.
Good.
Sworn for.
Mr. Dykeman has not been sworn yet, so we would need to swear him in.
Okay, very good. Mr. Dykeman, if you could please raise your right hand, I'll administer the oath. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you.
Mr. Dykeman, in preparation for this docket, did you sponsor responses to interrogatories submitted in this proceeding?
I did.
And at this time, do you have any corrections to those interrogatory responses not previously identified in the record?
Do not.
Okay. And at this time, do you adopt those interrogatory responses as your testimony in this proceeding?
I do.
Thank you.
Thank you. Okay, I'm not sure if Attorney Wheel heard your first announcement. The company is waiving cross of the OCC's revenue requirements witness and the company is waiving cross of the OCC's revenue requirements witness and OCC's rate and rate design witness. I do believe the authority has questions for the OCC's rates and rate design witness, but we can regroup on that. I can poll the other parties and see if we just want to get Mr. DeFever in here to adopt his testimony.
Thank you. Yes, that would be, I mean, if no one else has cross, we could certainly have Mr. DeFever come in here just to adopt at any point today. He's here until tomorrow.
Okay, thank you.
Thank you.
I had authority staff, EOE, and the Attorney General also listed on that panel. I don't need an answer now because we'll continue with this panel, but if the other parties can consider whether they are also affirmatively waiving cross. We will take that up after we complete this panel. Attorney Tisler, thank you. Is there anything else?
No, that is all for the company.
Very good. Thank you. Attorney Keenan, please.
Good afternoon. My next few questions are regarding the legal expense. I have some questions regarding attachment 1 to the company's response to interrogatory Pura 3. I'd like the company to describe the nature of the services performed by 3 of the line items listed in attachment 1, and if applicable, explain why such services are not connected to a docketed Pura or court proceeding. And the first item is line 33, Keegan Werlin, State Regulatory Legal Services, State Regulatory Legal Support. The next one is line 36, Jebson Rothorn, the same description. And line 37, I'm probably pronouncing it incorrectly, Rothorn Law LLC, same description. If you could provide a general description or a high-level description of these services.
Okay. We don't have the specific matters that they worked on here, but we can take a late file to provide what the specific matters were that each of those law firms were involved in. They were state regulatory matters.
So to confirm, is that late file 70 to provide the detail in terms of specific type of work?
Yes, please. And I have another question. It's regarding lines 31 and 32. Would the company explain what the pilot hydrogen project that the company is referencing in those 2 lines, what it is and the nature of the services performed for that project? For example, is it related to the Northeast Hub proposal?
Yeah, so we're gonna have to take a late file on that as well. These are specific legal matters and the revenue requirements witnesses may not have, in-depth information as to what those matters are.
Do you want to combine that into late file 70 or a standalone?
That's fine to combine it with late
Okay,
file
thank you.
70. Does the
Excuse me, sorry, just to confirm, is that lines 30, we have them combined 31, 32, 33, 36, and 37?
Yes, 31, 32, 33. 36 and 37.
Great, thank you.
Correct. In that late file, can you also identify whether any of these entities provide lobbying for the company? My next question is regarding the allocation factor. Does a 1 allocation factor or 1.000 allocation factor indicate that the expense is allocated 100% to Yankee, and anything less than that indicates that a portion of the expense is allocated to Yankee?
That is correct.
Thank you. My next question is regarding late file exhibit 1 SP01 schedule WPC-3.21, which is the legal expense schedule. Why did the company escalate some legal expenses, i.e. claims and litigation, regulatory matters, property taxes, and corporate, but not others, such as telecommunications, employee benefits, and transaction?
So we would have escalated all of those. It's just you're not seeing an amount in those for those particular line items because the escalation was too small. It didn't change the amount of the test year pro forma. It was too small.
Okay, and based on what were the legal expenses escalated?
They were escalated by GDPPI.
Okay. Thank you. My next question is regarding the company's response to RRU interrogatory RRU 8. And in attachment 1, the company provided the 2023 Eversource Energy Legal Department guidelines and billing requirements for outside counsel. And based on my read, it appears that this document is provided to an outside law firm after the law firm is selected by Eversource, correct?
These policies are posted on our legal billing system. So once they have been once they've been engaged, I guess, for a matter, then they have access to the document.
Okay, thank you. Would you describe the policies, practices, and procedures the company undertakes in selecting an outside law firm? For example, does it issue an RFP? How does the company determine what legal fee is appropriate?
So RFPs are used for larger matters where there may be a larger effort involved. And then the company would approve any billing rates that are received from the law firm as part of that process.
Thank you. When you say larger, is there a cutoff amount, or how do you determine when an RFP is issued?
I think if we would need to take a late file on that to determine, if you're looking for specifics about the size of a case that might involve an RFP and might not.
That's okay, thank you. Just have a few questions regarding the mutual aid expense. In attachment 1 to the company's response to interrogatory OCC 107, the company states that NGA does engage in lobbying activities, but it notes that the invoices in attachment 1 of the interrogatory response do not indicate any lobbying activities included in such billings. Does the company know whether the dues it pays to NGA are being used for lobbying activities?
I would say that the company does not know, what lobbying NGA is doing, based on what the invoice indicates there. It's not itemized on the invoice.
So you don't know if your membership dues are used for lobbying?
Well, the membership dues would be used by the organization, and however its operating plan,
Okay,
is used.
thank you. If you could turn to attachment 1 to the company's response to interrogatory RRU 359. And in attachment 1, the company provides the mutual aid reimbursements the company received from 2 utility companies for mutual aid the company provided in 2018 and 2019, which includes an administrative charge. And in its response to interrogatory RRU 359, the company stated the administrative charge is for back office support. Would you please provide more details regarding what the administrative charge constitutes?
And what subpart of the question is that response in?
So the attachment provides a bunch of items, including an administrative charge. But in the body of the response to interrogatory RRU 359, the company stated the administrative charge is for quote unquote back office support. And I'm just trying to understand what that means.
Yeah, no, I was just asking, is that in part A, B, C, D, or E, or F, where you're seeing that?
I'll just direct the witnesses in subpart B.
Thank you.
Thank you.
For example, is it labor, office supplies?
Yeah, I don't want to speculate on what exact costs are in the administrative charge, so we would have to take a late file on that.
Okay, thanks. Thank you.
Would you like that late file?
Yes, please.
Late file exhibit 71.
Thank you. In response to interrogatory RRU 57, the company states that NGA dues and associated membership allow for members to participate in the mutual aid agreement between not only NGA member companies, but also American Gas Association member companies and some other member companies. Would the company be able to participate in the mutual assistance agreement referenced in this interrogatory response or any other mutual assistance agreements if it were not a member of NGA?
I think we would need someone from operations to respond to that.
Thank you. I'm turning now to postage expense. In attachment 2 of the company's response to interrogatory OCC 170, the company provided the number of customers who enroll in paperless billing from the test year to the rate year. What methodology did the company use to estimate the number of customers expected to enroll in paperless billing?
I know we have that. I'm just having trouble putting my fingers on it right now. Excuse me. I think we could provide that as a read-in. So the question was this, how did we project the increase to the customers enrolling in paperless billing?
The methodology the company used to estimate the number of customers expected to enroll in paperless billing? Because I understand that's
Definitely.
the savings that you're removing from the postage expense.
Correct. Yep.
Thank you.
Yep. Thank you.
Okay, that will be read in W.
Okay, I now have some questions regarding the rent expense. In its response to subpart C of interrogatory RRA 5, the company states that the test year rent increase at 157 Corderville Road, Southborough, Massachusetts, is due to the utilization of property. How did the utilization by Yankee change at that location?
I'm so sorry. Can you repeat the reference again?
Sure, it's subpart C of interrogatory, of the response to interrogatory RRA-5. And it's a question regarding 157 Corderville, Cordaville Road in Southborough, Massachusetts.
So the Southborough, Massachusetts, and I do have a breakout, one of the other. Okay. Okay. Yep. I'm just looking at OCC 255 attachment 1 as well. So there's you're asking about the Southborough, Massachusetts, the 157 Corderville Road.
Yeah, I'm
Yes.
asking, yes, it says the company states that the test year rent increase at that location is due to the utilization of the property. And I'm asking, how did the utilization of the property by Yankee change?
It's on the record. I'm just grabbing it and reading it.
Thank you.
Okay. I was just pulling up RA. Okay. So based on our understanding, subject to check, so I may have to take a read in if you have further questions. The corporate office space and the gas control center for Eversource gas companies, including Yankee, is included in that building. And we did see an increase to that buildings of about 62,707 reflected in the rate year.
It-
And if I could just pause for 1 second. Okay, thank you.
So how did it, what was the change? I guess, and how did you quantify? Or how did you determine that it's the amount that you just stated?
So the quantification is based on a calculation that's performed at the corporate accounting level where they do like a revenue requirements calculation to ensure that all of the intercompany affiliates are appropriately charging each other so that there's no cross subsidization. In terms of the charges, the charges themselves are also based on the square footage. So it depends on which operating companies, affiliates, or business segments are sitting in the building. So that's also a determination in how the costs are allocated. In this case, it's a causal methodology. And for the facilities, for all the major buildings, they actually have their own causal allocator code that's based on square footage and occupation of the buildings.
Okay, so how, I'm still, I guess I'm trying to understand how Yankee's use of this building changed.
Yeah, we can take a read-in, just so what's on the record is the only information I have, so we can take a
Okay,
read-in.
Sure, so if you could provide how the utilization by Yankee changed at this location, and then how the additional rental cost of that changed utilization was determined.
Sure.
Thank you.
Let's read in X.
Thank you. In its response to subpart A of interrogatory RRA 8, the company states that the Westboro facility is being used to consolidate leadership and to accommodate a combined gas control center supporting Yankee, EGMA, and NSTAR Gas. What is the total rental cost of the facility for which Yankee is being allocated $965,439 in the rate year?
So that again is the cost associated with the individuals that are sitting in that facility that support the Yankee Gas Services Company.
What was the total cost? of the facility.
Oh,
So
for the
Yankees-
entire facility?
Correct.
Okay, 1 second.
Thank you.
Okay. Can we take a read-in? Is that possible?
Sure. I have a few more questions.
Related to the
to this.
building?
Yes. Shall I ask them?
I'll try to answer.
Okay.
Sure.
How was the rental cost determined?
In terms of the allocation, so I'm going to have to, in terms of
In terms of the total facility?
the total facility. So if I could also, I think you're looking at, this is an N-Star gas owned facility.
Okay.
So subject to check. I have my, subject to check, what I would expect to see is in the N-Star Gas last rate case decision as approved by the Mass DPU, what is happening is you will see the net plan assets that are calculated annually. That is, again, a standard rate-based revenue requirement calculation. So in the first area, you have essentially your rate base. So it's taking the value of the building less your accumulated depreciation. Then you have your billing components. The first one is your rate of return, and the second one is depreciation. The third one is the taxes. So I would expect that all of those three components, or at least the two, the rate of return and the depreciation, is aligned, subject to check with the Massachusetts team, is aligned with our N-Star Gas last rate case decision, so that there's no cross subsidization in terms of what is being paid for by N-Star Gas customers and what is being occupied in the building for and on behalf of Yankee Gas.
Okay. Thank you. As part of the read-in, when you provide what the total cost is, could you also provide what that total cost is based? Is it NSTAR's revenue requirement in the last rate case? Or what the amount, the total cost is based on?
So the total cost as is calculated before there's any allocation, causal or common or direct, that's based on a standard regulated revenue requirement cost of service calculation. So the components that are put in here are the actual plant in service. So the value of the building, the accumulated depreciation as of that point in time. So you'll see your plant in service and your accumulated depreciation from 2023 into 2024 in OCC 410 attachment 3 redacted. You'll see that those are changing. So it is based on the company's books and records as audited. I believe subject to check the end of the year, but I will confirm that if that is not the case through redirect. Then that net plan in service, again, based on the company's books and records as audited, the billing components tie back to your Mass DPU rate case decision in NSTAR Gas's last approved rate case. And so your calculations there slow down just like any standard revenue requirement cost of service. And then you get to your total. That total value, that's the total cost that is then applied across all of the operating companies to ensure that there's no cross subsidization. And that again is part of our time and expense charging policy, where we have to ensure that any facility that's owned where we have affiliated companies occupying, we need to make sure that the customers are being held harmless if it's a shared facility.
Thank you.
And this actually goes both ways because keep in mind, Yankee Gas has rental revenue, and we have that in at Yankee Gas as well. So it's both ways.
So just to clarify for the record, is the only piece the witness still has to provide for read-in why the total number from which a subpart was allocated to Yankee Gas? Is that correct? Thank you.
Yeah. Excuse me. Yes, that's what I have.
Can you explain why you're using an allocation based upon the percentage of gross plant assets instead of another metric, such as utilization of the facility?
Can you show me a reference? Oh, are you pointing to the actual methodology? That's what you're pointing to?
It's subpart A of the company's response to interrogatory RRA 8. They're saying it's based on a percentage of gross plant assets. And we're just asking for an explanation regarding why the company used that allocation metric instead of, for example, utilization of the facility to determine costs.
Okay, just wanted to confirm. So the first level of allocation is based on square footage and facilities. This particular part of the building is occupied by the gas operations team. Their leadership team, because of the area that is occupying this building, because they are capital intensive, capital infrastructure, their causal allocator is the gross plant asset. So it is plant asset related. 1 second. Could I make that as part of a read? And I want to make sure I get it precise because there's a two-step process and I just want to make sure I explain it properly.
That would be great. Would you mind adding that to the same, was it Y?
Thank you.
Thank you. And so that will explain why the company used the percentage of gross plant assets instead of another metric, such as utilization of the facility. Can I request as a late file exhibit what the amount allocated to Yankee would be if the utilization of the facility metric were used instead of the percentage of the gross plant assets metric?
Yes.
Late file exhibit 72.
Thank you. And where did the company house its gas control center prior to being combined and housed at the Westboro facility?
We're going to have Mr. Kelly and folks from the gas operations side of the organization in the capital panel. If I could do a read-in or we can defer to Mr. Kelly to explain if you have further questions. I can certainly take a read-in and speak to the gas ops team.
Well, my next question is, how is the prior location currently being utilized?
Yeah, I won't have that answer. I'd have to speak to the gas ops team and facilities management. This is all dealt with, again, within the functional areas of the organization. The information that we put on the record was the calculations underlying all of the controls in place that we have at the organization to build it. So this level of detail, I really respect the questions, but if it's okay to take the read-in and speak to the experts to get you this level of drill down, that would be great. Thank you.
1 second.
I just want to clarify, is a read-in acceptable to Mr. Cadwalader, or do you want to produce them as a panel later and they can answer the questions?
I was actually going to request a late filed exhibit, so then if we had any follow-up questions, we could do so at the late file hearing. So would it be okay to make this late file exhibit 73? And the information we're requesting is, where did the company house the gas control center prior to being combined and housed at the Westboro facility? And 2, how is the prior location currently being utilized?
Late file exhibit 73.
My next question is regarding subpart B of the company's response to interrogatory RR8. In that subpart, the company states that the costs under its new lease agreements for facilities in Waterford and Newtown are much less when compared to other options available to Yankee from third parties. What steps did the company take to determine the cost of other options to Yankee?
Again, that would require a facilities team to provide that response. That response was received with conversations with our facilities management team.
I just want to make sure I'm looking at the right response. RRA 8 has the witness, Ms. Peruta, Mr. Shelnitz, and Mr. Murray. Is that not what we're discussing?
That is correct.
Okay. So there's an additional witness that you need, that it does not appear on this interrogatory. Is that?
I would say yes. And so the revenue requirements team can provide the very high level information regarding the information in here, but for a more detailed request regarding specific facilities decisions, we're happy to produce a late file exhibit and we can produce a facilities witness at the late file hearing.
Okay. Attorney Keenan, where are we at? Late file exhibit 74. You want to restate that prompt for me,
Sure,
please?
thank you. So this is regarding subpart B of the company's response to interrogatory RRA 8. What steps did the company take to determine the cost of other options to Yankee? My next question is regarding subpart C of that same interrogatory. I will ask the question and we'll go from there. In its response to subpart C of interrogatory RRA 8, the company states that the 21,528 square foot previously occupied by Beth Israel has been reallocated to NSTAR Electric Project Management Groups, or NSTAR. And the 22,370 square foot previously occupied by Telestream has been reallocated to ESCO. What allocation of rent expense from NSTAR to Eversource is Yankee entitled to receive based on the use of Yankee's facilities by these subsidiaries?
So can you confirm which facilities you're referring to for me?
Yeah, it's the facilities previously occupied by Beth Israel that's now, that's been reallocated to NSTAR, and the facility previously occupied by Telestream, which has been reallocated to ESCO.
Okay, I was confused because you said rental expense, and this is rental revenue that NSTAR, the operating company who owns the Westwood facility, was receiving rental revenue from these tenants.
Mhm.
That rental revenue is actually, and let me just get the schedule for you, one second. In OCC 255 attachment 1, on that fourth line item, you will see that rental revenue from Westwood, and we disclosed every year since 2019. So you will see a reduction in your total rental expense as a result of Yankee Gas actually receiving a portion of that rental revenue through what I would likely describe is the allocation of the total facility occupancy, and then a give back for the occupancy of the building where there are tenants in the building, where we're getting outside revenue, flows through NSTAR Gas, goes back to the affiliated companies. Please bear with me one second.
And so what I'm trying to understand is prior to NSTAR and ESCO occupying this space, Beth Israel and Telestream did, and they provided rental payments to Yankee, correct?
Not to Yankee. It would flow through the shared service company because the shared service company employees are occupying who are serving Yankee Gas, if that makes sense. So you receive it that way. The rental revenue. So sorry, I didn't mean to do that.
Okay, so Yankee was definitely receiving.
It is, yes, and you will see that in OCC 255 attachment 1 on the third line. So Yankee Gas was ascribed a portion of the rental revenue that was received as a result of the Westwood facility having occupants outside of the Eversource conglomerate. And you'll also notice that in the rate year, And also from test year to 2024, that did go down because of the reason that you indicated. We had 2 tenants that left the building.
So is Yankee no longer receiving an allocation for this property of a rental income?
There is, as we indicated in our response, there is 1 tenant left that we are continuing to receive rental revenue from. So Yankee Gas does have a little bit that is flowing through from the shared service company that's getting allocated and distributed down. And so we do have that included in our rate year 1 in the last column. And you'll see that on the 3rd line item, external rental revenue.
And what's that amount, please?
It is $26,000. And again, that is a portion of the amount received that is provided and allocated down based on the methodology, whatever the rate code methodology used is.
And how is this reflected in the rate year?
That's it right there. If you look in that last column, so you have your in OCC 255 attachment 1, you have your first line item, which is your internal rent expense. You have your next line item, which is your external rent expense. Then you have your external rental revenue Westwood. And then you have your capitalized rent. So if you look at the rate year 1, in the last column, you'll see 4.6 million for the first item, 147,000 for the second, rental revenue of -26, and then the capitalized portion of 808. Your total rental revenue, your total rental expense is on the final line item, which is 3,905,000, and that actually ties to your C-3.26 in your rev rec exhibit, LFE-001 SP.
Thank you.
Good afternoon, Steve Cadwallader with Authority staff. Just to follow up a bit on the portion of the facility that was occupied by Beth Israel and Telestream. It seems like if those 2 entities are no longer occupying that space, but it's now occupied by NSTAR and Eversource, it seems like Yankee should either be getting an allocation benefit because now NSTAR and Eversource occupy more of that building than they did before, or there should be some income allocation to Yankee's benefit. And I guess I'm puzzled as to why that's not happening in the case, or if you could explain where it is happening.
Yes, I understand your question. It's a good one. I will attempt at a high level, and then I will likely need a late file exhibit just to get the detail for what I can look at in 2025. Because if I look at the 2025 information, you're in the allocations, because there's an allocator that determines the chargeback. So I need to understand the square footage there. But at the start, the entirety of the building starts as a total line item. This building has a revenue requirement. That revenue requirement has to be met in some way, shape, or form. The occupants of that building are going to be subject to the revenue requirements. So if you will allow me to include that late file exhibit, it will help to answer that question. But I don't have that at my fingertips, that 2015 calculation.
A late file would be great.
Thank
Thanks.
you.
It'll be late file exhibit 75.
Do you need that, the late file restated or?
Yes, please.
Okay. This would be the space that was previously occupied by Beth Israel and Telestream, now being occupied by NSTAR and Eversource, and how that impacts the revenue requirement for Yankee Gas in the rate year, if that's clear.
Yes, thank you.
Right, 1 second. My next questions are regarding the uncollectible expense. And I'm looking at late filed exhibit 1, SP01, schedule WPC-3.28, page 2. Can you explain why the company increased the conservation adjustment mechanism, or CAM, revenue from $17,877,000 in Yankee's initial application to $20,846,000 in late filed exhibit 1, SP01?
Thank you. Sorry about taking so long to get there. So I would just refer back to our original late file 1 exhibit, YGS RevRec 2 ABCD schedules that was filed on March 28th of 2025. So in our response to, I believe it was RRU 237, there was a company identified error in our Schedule E 3.4, which is actually sponsored by our rates panel that will be coming up after us. But as part of that, we performed an update to correct for company identified errors. Test year updates included firm revenues at base rates and CAM revenues. So that was provided in the summary tab, once again, of late file 1, the original one, not supplement 1, filed on March 28th, 2025. March 28th, 2025.
It was included in the March version of late file exhibit 1, but not the most updated version. I think it's getting very confusing because we have already a couple versions of late file exhibit 1. Interrogatory responses are still coming in, probably as we speak. And so I'm just trying to make sure that it's clear in the record why there are changes.
Just opening up one more file. So you were comparing, just so I have it correct, late file 1, supplement 1, which was labeled at the end of revision 2. That's work paper C328, page 2 of 2, specifically the CAM line.
I'm trying to understand why there's one amount in the most recent version of late file exhibit 1 when compared to the initial application. I'm trying to understand why there was a change in the CAM revenue amount.
So I won't be able to speak to the detailed changes in that. What I can speak to is so we filed 2 cost of service updates. So the initial application back in November 24, we filed our first cost of service update on March 28th of 2025. In that cost of service update, we identify in the summary tab all the updates we made. That CAM change was one of those.
I'm trying to figure out why it was made.
I'm
I
sorry,
know the
can't-
change was made, but
sorry.
I need to know why it was made.
Yeah, I'm sorry. I can't speak to that. Those changes are specifically sponsored by the rates panel. They're very in-depth schedules. I don't have the
Even
details.
though but it is regarding a C schedule change.
Yeah, I believe C 3.1 also is sponsored by the rates panel. Let me just, because that's where we refer back to. Let me just double check that for you.
Thank you.
Yeah, so the schedule C 3.1, I know it's probably a little confusing because it is part of the overall model. There are specific schedules within here, such as C 3.1, which the witness responsible is listed as Edward Davis, who's part of the rates panel.
Okay.
The calculations all, I believe, stem from the E schedules, which flow through the C schedules, actually the C 3.1 schedules. So I just don't have that information as far as the detailed differences, but we did identify it in our first cost of service updated filed on March 28th.
Okay. So I need to ask the rates panel that question. Is that correct?
Yeah, I believe they would know the details behind that.
Okay, and I should probably then also ask them if CAM is a separate charge on gas bills and has its own reconciliation mechanism outside of base rates.
No, we can confirm that. That is true.
Okay, thank you. And when calculating I think this panel will be able to answer this question. When calculating the CAM rate, did Yankee include the uncollectible expense to derive the CAM revenue requirement?
That's correct. There's no uncollectible expense recovered through the CAM, which is why we do reflect a representative level of uncollectibles in the base distribution rate calculation here in C 3.28.
So Yankee did not include the uncollectible, when calculating the CAM rate, the company did not include the uncollectible expense
Correct.
to derive the CAM revenue requirement?
Correct.
Okay.
I just want to make a comment in terms of the question that was raised regarding producing the appropriate witnesses. So we have produced a revenue requirements panel who are endeavoring to respond to all questions regarding revenue requirements. We do have a separate rates panel, and so we're happy to, we want to make sure we get the authority, the information you need. We could either provide it in a late file, or when we produce Mr. Davis on the rates panel, we're happy to revisit that topic, whatever works best for the authority.
I appreciate that, Attorney Pace. I think the frustration that you're probably sensing at this point is that we tried to ask several of these questions to a different panel last week, and we're told to ask them to the revenue requirements panel. So we specifically went through our questions and identified who the witnesses were for the interrogatory responses that correspond to, and each of those witnesses is on this panel, and we're asking questions about the C schedules. So if the witnesses are being produced to just testify to the actual numbers, and we need to, who are the witnesses that can answer the substantive questions? Because it feels like what we're hearing is these witnesses can testify to the numbers on the paper and not a lot more. So should we pause the questions and direct them to the rates panel, or
No, I appreciate the question. And so the intent in terms of staffing a panel is to try and make sure we produce the witnesses that are most responsive to the questions we expect to receive. But in a case this large, we can't anticipate every single subject matter that could be received. And so, but we do have personnel available either at a future panel or in a late file. And so the witnesses are doing their level best to try and provide the information they have. but of course want to make sure that it's accurate. And so we're using a process of, where necessary, read-ins or late files, or deferring to the appropriate panel. In this case, Mr. Murray explained that because it's a cross-reference of the D schedules, and that's sponsored by the rates panel, late file 1 is really an incorporation of lots of different data from the docket into a late file that reflects the update to the cost of service. That's not just an input from one team, it's inputs from lots of other teams. And so we'll continue to try and do our best to be responsive and identify how we can get the authority, the information you need to do your job and to build a record. So we appreciate that. We'll continue to work with you to get you the information you need.
I appreciate that, Attorney Pace, and I'm not trying to belabor the point, but we first tried to organize our questions by substance and directed them to the Employee Benefits and Compensation Panel. And we're told that that the substantive questions needed to be directed to the Revenue Requirements Panel. So I think we're really just trying to figure out what the company wants, because when we organize them one way, we're told to do it the other way, and vice versa. So if we can keep going, and if the witnesses just want to say, please direct that to a specific witness, especially when we're asking them questions about an interrogatory that they've sponsored, I think that would move us along quicker, please.
Yeah, of course, we will follow that approach, and again, do our best to provide the information we can. If they're not able to respond, we'll identify what the options are available to get the information into the record.
Okay,
Thank
thank you. Attorney Keenan, please.
Thank you. I'm now turning to the vehicle expense. Schedule WPC 3.29 of late filed Exhibit 1 SP 01 proposes a vehicle depreciation expense of $461,000 for the rate year. However, Schedule WPC 3.31 of the same late filed Exhibit 1 proposes an average depreciation annual accrual rate for transportation equipment, which is FERC 392, of 2.44% applied to rate year average plant in service, totaling $37,493,000 to calculate the rate year vehicle depreciation expense of $914,829. Would you please reconcile the disconnect between the vehicle depreciation expense in Schedule WPC 3.29 of late filed Exhibit 1 SP1 and the depreciation expense proposed in Schedule WPC 3.31 of the same late file Exhibit 1 exhibit?
Okay, let me just organize that for 1 minute.
And I can point out that prior to the update to Schedule WPC 3.31, that prior to the update to late file Exhibit number 1, the disconnect between those two schedules appeared to be an amount of roughly $600,000 in favor of the company. And now the disconnect appears to be an amount of roughly $450,000 in favor of the ratepayers. So we're trying to understand the disconnect between the two schedules.
We can take a read-in. Those two schedules cross Mr. Murray and I, so we'll discuss and then read-in. I see what you're saying. I just want to make sure that we confirm and cross-check on that.
Thank you.
Let's read in Z.
If I could also add quickly, this may answer your question. When we updated our LFE schedule, we initially updated it focusing on certain items that were discovered throughout the proceeding, and then any changes, significant material changes associated with the rate base and the capital investments. This particular item that you noted is a change in the rate base capital expenditures for which there is what I'll call a three-step link to the vehicle section.
Okay.
So the company will be updating LFE 001 to flow through the LFE 001, all items that have been updated as a result of the LFE 001. We were focused at the time of the filing on the rate base items. So that depreciation expense that you saw flow through, the support for that was the update for the capital investments.
Thank
So
you.
that should help.
Wonderful. Thank you.
Attorney Keenan, do we still need that as a read in Z, or was that?
Yes, please.
Yeah.
Okay. I'm now looking at, I have questions regarding the company's response to interrogatory RRA-4 and RRA-7. In table 1 of the response to interrogatory RRA-4 regarding the vehicle insurance cost, the company states that it used a 6% annual escalation factor from the test year to the rate year to determine expected policy renewal premiums for the rate year. However, in subpart C of its response to interrogatory RRA-7, the company explains that the increase is due to the overall auto liability insurance market seeing significant increases in claim frequency and associated costs. My question is, what changes have occurred in policy renewal premiums between the test year in 2024 as well as up to the present date in 2025?
So I do not have the premiums at my fingertips for 2025. I can get those for you. This was disclosed in January of 2025, so any new premiums subject to check. It is June. We may have those, but subject to check. If not, there could be enough information at this point in time that we are in June where we would likely have information to provide on the record in terms of an escalation factor that is different than what was used at the time of the application filing in November of 2024.
Okay. Do you know what the premiums were for 2024?
I have in my fingertips what my premium policy increases were, but it's going to take me a couple of minutes to pull it from my records in my binder. So I can do that as part of the read-in as well.
Is the test year premium amount clear? What the vehicle insurance cost before the 6% annual escalation factor was added to it? Is that clear in the record?
Let me go to the schedule. 1 second. Okay. So I want to make sure I answer your question appropriately. If you go to, and this was part of our rate case application as well, but I'm using LFE 001 SP01. If you go to WPC-3.29, page 1 of 1, you'll see the vehicle expenses there. The insurance costs that you see identified on line 27, those are coming directly from the system. The pro forma adjustments are just taking those test year costs with any costs associated that are pro forma'd out because they were journal entries for prior period adjustments, so they were not test year related. So it added up to roughly $2,000. So we took those out. The test year pro forma was then your 134,000, and then your rate year one adjustment is the escalation factor, correct?
Okay, thank
So
you.
hopefully the read-in will provide you the information.
I don't even think I need the read-in. That was helpful. Thank you.
Okay, you're welcome.
Okay, my next question is regarding sticking with table 1 in the company's response to interrogatory RRA-4. And the company states that it used GDPPI to escalate the test year fuel cost to the proposed rate year level. How does the fuel cost in 2024 compare to the test year fuel cost?
So I don't have that one at my fingertips. I do not have the fuel expense for 2024, but I can certainly put that in an LFE for you.
Let me see what the rest of my questions are. One second. I'm going to move on. No need to provide a read-in. My next question is regarding schedule. It's probably the same schedule we're in, the vehicle expense schedule. The company proposes property taxes as a separate line item in the vehicle expense. And I just want to confirm whether these taxes have been excluded from Schedule C-3.34, which is the property tax expense schedule.
That is correct.
Thank you. Okay, in its response to interrogatory RRA-7, the company states that the property tax expense as a percentage of the transportation equipment value in account 392 is approximately 1% for the rate year as well as the test year. I would like the company to provide a late filed exhibit in the form of an unlocked Excel spreadsheet that includes the following information. 1, the transportation equipment that is in service and benefiting customers as of the close of record in this proceeding. 2, the date on which the equipment went into service and began benefiting customers, including reference to the document or documents in the record that show the transportation equipment is in service and benefiting customers. And 3, the value of the transportation equipment.
Attorney Keenan, I missed that last one. If you could just,
I'm sorry. Do you want me to read the whole? Would it be helpful if I read?
just the last piece I missed.
Sure. Number 3 was the value of the transportation equipment.
Thank you.
And that is late file exhibit 76.
I have one question regarding the O and M residual, and I'm not sure if this panel will be able to answer it. But it's my understanding that the O and M residual has a number of contracts that underlie it for all of the line items or all of the items included in the O and M residual. And I would like to confirm, or I'd like to ask if the company has contracts in place in the rate year for the services provided by all of the vendors that provide the services listed in the O and M or included in the O and M residual.
And just to clarify that question, so, the company has, of course, contracts, then we also have purchase orders, which have terms and conditions attached to those. Then we also have purchases beyond a certain amount for which a contract is not required. And so maybe we can have the revenue requirements work with the procurement witness to respond to the question.
I can certainly explain at a high level how the contract process works. So specifically for Yankee Gas in 2024, we have roughly 7,000 purchase orders issued and about 450 contracts, okay? Everything we purchase falls under either a purchase order or a contract. Typically, contracts are things where you've got longer-term engagements and procurements where you're using recurring services or buying recurring materials over time. With POs, and by the nature of a PO, under the Uniform Commercial Code, a PO is a form of a contract as long as it has four essential elements, which is offer, it's called mutual assent, offer and acceptance. Number two is consideration. So when you cut a purchase order, there's a price associated with the cost of the service that you're procuring at that specific point in time. Number three is legality of purpose. And obviously, when we cut purchase orders, we're doing it for legal purposes. And number four is competent parties. So anybody that's able to cut a purchase order for Eversource is an authorized agent of the company that reports under the procurement organization. So for 2024, 2025, roughly 91% of our spend is under contract. Okay, and in some cases, we don't require a contract because it's done on a purchase order. From a purchase order basis, roughly 60% of the POs are covered under a contract.
Okay.
But when we contract services, there is either a contract or a PO that governs the terms and conditions associated with that specific purchase.
Okay, thank you very much.
You're welcome.
Okay, and I'm going to circle back, if you don't mind, to the fuel, and I think I will ask for a late file exhibit if you wouldn't mind providing one regarding, so it'll be a late file exhibit, and I like the following information provided: the fuel cost in 2024 compared to the test year fuel cost, as well as the fuel cost up to the present date in 2025. And how these changes in fuel costs compare to the GDPPI.
Got it. Thank you.
Thank you.
That's late file exhibit 77.
Okay, and my last set of questions, oh, no, I apologize. I shouldn't have said that. I'm going to go now to property tax. And I have a few questions regarding page 16 of Schedule WPC-3.34.
I'm there.
My first question is regarding the line labeled Projected Additions 2024 LY. And my question is, does this line item reflect plant placed in service during calendar year 2024? Or does it correspond to a different period?
Yes, those are calendar year 2024.
Thank you. My next question is regarding the line labeled Projected Additions 2025 LY. And does this line item reflect calendar year capital additions in 2025 or some other period?
No, that's correct. 2025 calendar year.
Thank you. So line items labeled Projected Additions 2025 LY and Projected Retirements 2025 LY are hard-coded. Can you explain why these figures are hard-coded and not referenced in the schedule, in the B schedules? It's only the 2025 figures that are hard-coded.
Yeah, so we don't have calendar year amounts in the B schedules. So our test year was calendar year 2023, but our interim period was for the period 1/1/24 through October 31st of 2025. And the rate year was for the period November 1 of 2025 through October 31st of 2026. So the company has provided calendar year projected plan additions for these amounts, which correlate but cannot be found directly in the B schedules because of the timing of those schedules.
Okay, thank you. My next question is regarding the line item labeled depreciation 10% for second year. Can you explain what this line item represents?
Yes, so we have the footnote on a prior page. We probably could have copied it over to this page as well, but I'll read that for the record. So pursuant to Connecticut General Statute subsection 12-63B6, the depreciable value of tangible property in their first year of declaration is 95% of the acquisition costs. And then the tables go from there at 90%, I believe it's 80%, 70, et cetera. So what we've done here is we've depreciated according to those tables in that Connecticut General Statute I just cited. So in the first year on line 26 of your reference on page 16, we've depreciated 5%, which correlates to the 95% of the value. And for the second year of depreciation, we've represented 90% of the value or depreciating at 10%.
Thank you. Okay, I'm now turning to your pre-filed testimony on page 113 of the Revenue Requirements Panel pre-filed testimony. The company testified, quote, base historical amounts were those property taxes from the latest actual years of 2021 and 2022. And that's on line 6 to 7. And that these base property taxes were held constant, and that's on line 10. And my question is, why did the company elect to hold base year property taxes constant through the rate year rather than reflect depreciation of the underlying assets?
Can you just provide the page reference? I'm sorry.
I'm so sorry.
I have the exhibit up. I just missed the page reference.
Page 113. And the first quote was on line 6 to 7. And then the last one was line 10.
Can I just restate the question, just so I think I understand the question. The question is, why did the company hold the test year level of experienced property taxes flat in each of the rate years? And that would be, so on page, I believe, 13, line 19, we have 49,549,000. And similarly, on page 16, line 18, we have the same 49,549,000 as our base property tax.
Rather than reflect depreciation of the underlying assets?
Yeah, I think generally the company's experienced two factors. There's been depreciation on those assets, but also, an increase in the mill rates over time. So the company has not reflected any increase in those mill rates. The company also maintained that level of actual experienced mill rate from the test year. So that would be on page 6, line 76. I'm sorry, page 9, line 76. And we maintained that actual level of mill rate through the rate year. And I can cite those references if you'd like. It's page 13, line 76, and page 15, line 76. You'll see that composite mill rate has remained flat at 33.88% as well.
To clarify, you're saying that rather than reflect the depreciation of the underlying assets, the company instead kept the mill rate the same, and somehow that equals the same thing?
Yeah, let me just think about this for a few more minutes.
Thank you.
I apologize. All right, I think I need to take a look at the calculations to give you a better response to that. So I think we can take a late file for that. We can explain the methodology the company utilized and why we took the approach we did. That's the question, I believe, right?
And is that going to provide the difference between the two different calculations? For example, if you reflected the depreciation of the underlying assets, but used the updated mill rates versus not depreciating the underlying assets, but keeping the mill rate constant?
Yeah, we can look at the depreciation on the older assets. I think one of the challenges is there's not so all these assets, it's a pool, and each asset would be representative of a different year of depreciation. There's also, my understanding from the statute is there's a maximum depreciated amount. So these assets don't depreciate below a certain threshold. So certain assets in here would not be depreciable beyond what is already reflected in the test year. Which is why I think we need to take this as a late file to just further understand the underlying data. Because I don't believe it's as simple as saying we can apply 10% depreciation to a single line item, 20% depreciation to a different line item. It's a total population of assets that would be depreciated at completely different points in their useful lives based on the Connecticut statute. But we can certainly take that back and provide any analysis we can perform.
Thank you very much.
Late file exhibit 78.
Okay, next is payroll tax. I'm looking at attachment 1 of the company's response to interrogatory RRU 202. And I'm specifically looking at the payroll tax TYPF tab. And in this tab of attachment 1, the company calculated the FICA tax using a 6.2% FICA rate applied to the $8,799,862 test year pro forma adjustment. And my question is, how many of the companies and ESCO employees are projected to exceed the FICA wage limit in the rate year? Thank you.
Okay, so the question was, how many employees does the company expect to reach the cap for FICA?
How many of the company, so Yankees, and how many of the ESCO employees are projected to exceed the cap?
I don't have that specific information. I'm not sure if the question is getting at, did we apply a cap to this specific calculation here? The reason for the calculation is really, it's applying it to the rate year adjustments. And those adjustments are to reflect the merit increases of 3% for both union and non-union employees. And historically, we have seen the cap for FICA go up as well each year or every couple of years. So to the extent our FICA, so we utilize the test year level of FICA expense, and we're utilizing the increase to payroll and actually decrease to officer incentives and increase to employee incentives to say that is the incremental FICA related to those employees. And I think we would expect to see the FICA cap go up relative to the increase we're projecting for the payroll at a similar level. So we haven't included, if this is where the question, we have not included any cap related to the specific incremental FICA expense because of those reasons.
Okay, thank you. My next question's regarding the gross earnings tax expense. And I'm looking at late filed exhibit 1, SPO 1, schedule WPC 3.36, page 1. The company made the $870,000 adjustment on line 20 on page 1 of this schedule to remove the get expense associated with CAM revenues. Is that correct?
Can you just repeat the page reference again?
Sure. It's line 20 on page 1 of schedule WPC 3.36.
where we remove $870,000 as a pro forma adjustment.
Correct.
Okay,
And you made that adjustment to remove the get expense associated with CAM revenues, correct?
that's correct.
And the reason the company is proposing this adjustment is to remove the get expense related to CAM revenues from the revenue requirement because Yankee is not including CAM revenues in base distribution rates, correct?
That's correct. For whatever reason, the way that the revenue requirement model is set up, it has historically included the CAM, which is a separate rate, a separate rate reconciliation mechanism. So we remove it. We remove the CAM on both the expenses and on the revenue side from the revenue requirement model.
Thank you. Okay, I now have a couple of questions regarding the income tax expense. If you could turn to the company's response to interrogatory RRU 131. The company states in subpart B of this response that it does not have any fixed capital investment credits to reduce state income tax expenses. Did the company utilize fixed capital investment credits or FCIC credits in the test year?
They were fully reserved. So there was subject to check in the tax return that was filed in September of 2024. There were none used because they were fully reserved against, and subject to check, they would not have been utilizable at Yankee Gas.
Does that mean that they expire? I don't know what you mean by reserved.
So the fixed capital credits are, there's an uncertain tax position, FIN 48, it's been now longstanding for about 17 years. If there is a position on the company's books and records that are likely not going to occur, there's a tax reserve placed against it. The fixed capital credits, if the tax department deems that they will likely not be able to use them, and a lot of the fixed capital credits historically have not been used because you're in a loss position, the 3-year period expires. And so what happens is those fixed capital credits expire.
Expired, that. Okay.
Correct.
Is that what you mean by reserve?
So the reserve, yes. So the reserve is required under GAAP under this FIN 48 FASB accounting pronouncement. So you have to reserve against it if you believe it's highly probable, more likely than not, that you're not going to use it. For Yankee Gas, we have not used them. So you will not see that. But again, subject to check in 2024's filed tax return, we did not use it.
Thank you. If you turn to Schedule G 2.0, the company includes a Connecticut State Investment Tax Credit of $3.327 million.
I'm sorry, where are you right now? Sorry.
G 2.0.
Thank you. Can you repeat the line item?
I'm looking for, I'm trying to find it again.
Okay.
So it's on page 2 of Schedule G 2.0, and it's on line 49.
If I can take a read in, I'm seeing all of my offsets there. And just to confirm and repeat your question on the read in so I get you the right answer.
So I believe the company stated that it has not used FCIC credits in the test year. However, this schedule includes Connecticut State Investment Tax Credit, which sounds somewhat like FCIC, of 2.327 million. So if you could reconcile those two statements.
Will do.
Read in AA.
Did the company use FCIC credits in 2024? You may have answered this previously.
In the 2024 federal income tax filing and the state tax, that has not been completed yet. That is still subject to being filed this summer. So we won't know whether or not those will be used until a full provision on the tax return is completed.
In state income tax.
The state will follow the federal income tax return, correct, but those won't be filed until after our federal income tax return is completed this summer, because I believe you requested 2024, correct? Yes, that's not completed yet.
And can the company confirm with certainty that it will not use FCIC credits in the rate year?
I can confirm that our tax experts have identified that the fixed capital credits have an uncertain tax position, which leads them to believe that it is more likely than not that they will be used.
Thank you. Are there any expired FCIC credits being sought for recovery in the instant proceeding?
I'm sorry, I have to correct the record. I said that it is more likely than not that it will not be used. I think I said that it will be used. Sorry.
Understood. Thank you.
I'm sorry, Attorney Keenan, we were all set if you were waiting for us.
I'm so sorry. Are there, I think you were checking to see if there's any, well, maybe there are any expired FCIC credits being sought for recovering in the instant proceeding?
Let me make sure I understand your question. You're asking if we are seeking recovery of any FCIE credits in the current rate case proceeding. So the FCIE credit
Expired.
Oh, expired. I'm so sorry. So the answer would be no, because they're unwound in the balance sheet. So if they expire, there's simply a balance sheet transaction. The unwinding happens in the balance sheet, so it would never flow through your income statement and your cost of service.
Thank you.
You're welcome.
Can I ask for a late file exhibit? I request that the company provide the FCIC credits that the company could use in the rate year, i.e. any of the FCIC credits that are not expired or will not be expired in the rate year.
Late file exhibit 79.
And I have one more late file exhibit. And it has to do with, I'm referring to Schedule WPC 3.37, pages 1 and 2. I would like the company to request that the company provide as a late filed exhibit, the source documents and underlying calculations for all hard-coded figures in pages 1 and 2 of Schedule WPC 3.37 and pages 1 and 3 of Schedule WPC 3.38 of the most recent version of, or the final version rather, of late filed Exhibit 1. And that's 1 through 3. In case I said 1 and.
That's late file exhibit 80.
Okay, and my remaining questions are regarding attachment 1 to the response to interrogatory RRU 341. And in this response, or in this attachment, the company provided the public company costs and where they're located in all of the schedules. And I would just ask if the company could walk through each item. For example, investor relations are included in payroll in line 29. Can you just describe what position that is or to what that relates?
Yeah, let me just pull that up. Okay. Online, is it okay to start with Attorney Keenan?
Sure, and there, under investor relations, there's a few, if you could, some might be grouped together, so whatever you think makes the most sense. I'm just trying to understand why the company identified these expenses as investor relations expenses.
So are you asking the question, I just want to make sure I understand the question. Are you asking the question how we determine that to be the amount? Is that what you're asking? Like how the company came to that decision in this rate case application?
No, so you've identified a portion of the payroll expense as investor relations, and I'm asking, is it related to a specific position that you've identified as I'm trying to understand
Yes.
why the company chose all of these
Yes.
line items.
Sure. So I just wanted to make sure I was responsive. So when we pull the schedule together, so the question asked for Schedule G210 regarding other public company costs, provide a schedule line number where each of the costs listed in attachment one of the company's response is recorded. So we to pull the original charge for what was the investor relations cost, there are cost control centers that are investor relations specific, and any work that is performed defined as investor relations, which is of course board meetings, shareholder meetings, traveling for meetings with any investment analysts, potential investors. That is happening in an investor relations department.
Okay.
So, okay.
So these, the payroll benefits and benefits line items here were linked to a CCC code?
That is correct. So, the investor relations organization, that cost control center, because it is sitting at the highest corporate level, that one is likely using a common allocator. Typically, a common allocator, over the last several years, Yankee Gas has roughly a 5 to 7% allocation subject to check.
Okay.
That is probably what you are seeing here for your calendar year and your rate year. The calendar year being the 2023 amount that was actually pulled from the system, that came through from the common allocator that was allocated to Yankee Gas. That's what we picked up.
Perfect. Okay, thank you.
You're welcome.
And then the O&M residual employee expense, do you know what that is?
One second, I might actually have that. Please give me a moment.
And I'm going to be asking these questions regarding each one of these line items, and if it's more appropriate or
It might be
provide it
later.
in a late file exhibit.
Let's do that.
Not that I want to add to the list of late file exhibits, but I'm just trying to understand what each item is.
I can give you global, obviously, for what's flowing through as your payroll benefits, employee expenses, dues and subscriptions. We have the breakdown there, but if I can give you the breakout in a late file exhibit, it probably makes more sense than to call it out one by one.
Thank you. That would be great. And my last, I just need to confirm that we have the 2023 state and federal tax returns are in the record.
Yes, the federal returns are in RRU 019 and the state return is in RRU 020. I'm sorry, RRU 020. You're welcome.
And before that, the late file exhibit that you requested was late file exhibit 81, and that's to walk through the itemization of RRU 341.
Attachment 1.
Attachment 1.
Thank you. And that's all the questions I have. Thank you very much to the panel.
Thank you.
Okay, that concludes authority staff's cross. We're going to take a break and then we'll resume with OCC cross for this. Oh no, it does not complete authority staff. Oh, Attorney Coker. Okay, all right. Hold that, Attorney Coker, please.
Good afternoon, Josh Coker, Pura Staff Attorney. So to start, please open the response to RRU 339 and attachment 1. In subpart B to your answer to RRU 339, the company was asked to quantify the total revenue requirement impact attributable to inspection costs associated with excavation permits for the rate year ending October 31, 2026, and to provide all supporting calculations and assumptions used to derive this amount. Do you see that response?
I'm just pulling it up. I apologize. I pulled up 329. You said 339, correct?
339.
Okay. Okay, yes, I'm there.
Yes. Okay, so if you turn to attachment 1 for this response, you'll see a table provided is titled Total 2018 to 2023 Inspection Costs on Excavation Permits, Net of Depreciation Aided. So my question is related to the time period used and why did it stop at 2023? Can you confirm that the company is not seeking recovery of any inspection costs on excavation permits after 2023?
Yeah, the company used the amounts from its response to RU 99 attachment 1, which went through 2023. I will have to confirm whether or not the forecasted capital additions included in the company's cost of service included any of these costs. I can do that through a read-in.
Can I get that as a late filed exhibit?
Sure.
Okay, so for that late filed exhibit, please provide an updated copy of the attachment that expands the date range to include all relevant costs, including post-2023 costs. Within the response, note which costs are actual versus projected.
Okay.
Second, I'd like to request another late filed exhibit. Please refer to Schedule H-1.4. Please provide an updated version of the schedule. Please provide an updated version of the schedule that reflects the company's final rate request in this proceeding. Reconcile all the line items are listed on page 2 of the schedule with the applicable amounts and the company's updated C schedules.
And those were late file exhibits 82 and 83 respectively.
Can I just ask the witness on late file 83, is it clear in terms of what is being requested and we can provide it? Yes, thank you.
You can provide that.
Nothing further.
Thank you. Now we can take our break. So we will break until 3:15 and we'll resume with Cross from OCC, please. Attorney Pace?
We have one of the read-ins that was requested during this afternoon's session. That was read-in W, and Mr. Murray will proceed to read that into the record.
Yeah, so the question was, how did the company forecast the adoption of paperless billing? So the company's digital data experts created a linear trend based on historical data. They took the adoption rates from previous weeks and months and used a linear projection to estimate how the trend would continue over the next few years. So that approach assumes the adoption rates will continue at a similar pace unless there's material changes. Thank you.
Okay, thank you. Attorney Wheel? Oh, I'm sorry, Attorney Pace, was there anything further? It was just that one review.
Nothing further. Thank you.
Thank you. Attorney Wheel?
We're going to start with some cross from Mr. Zablowski.
Good afternoon, Albert Sablowski, OCC staff. Could we please turn to Schedule C, WPC- Work Paper C-3.5, and also the response to OCC 147, Attachment 1. Just let me know once you're there.
Okay, we're there.
Okay, thank you. So the amounts are different, I think, for bank fees and debt service charges between these two documents. Could you explain why?
Did you say C 3.5?
Yes.
So if you go to line 36 in calendar year 2023, you're going to see the bank fees and debt service charges at 199,294 for calendar year 2023. Mr. Zablowski, is that what you're not seeing in C-3? 1 second, please.
Second.
Apologies, I had in my notes, I had tied it out with the delta being the investor relations, which is on the same schedule. So in my notes, I had that I tied it out to see 3.5. That variance is the investor relations portion.
Okay, thanks. Thank you for that. Are both included in the rate year, or is there overlap between the two? I guess between just amounts, it's just the investor relations that is the only difference.
That is correct. Yes, the only difference from the 199, 294 to what is disclosed in the test year is the investor relations portion.
Hi, Tom Wheel for OCC. Just one quick follow-up. Sorry to interrupt. So with the difference between the 252,169 on 140 OCC 147 and the rate year amount of 341 on the C schedule also be because of investor relations?
So you're on line 36 in OCC 147 attachment 1 in the rate year ending column, correct?
Yes.
Attorney Wheel. So you're saying 252, 169 rate year. And then you're comparing that to the rate year ending for our work paper C-3.5
Yes.
for that difference, yes. If you give me 1 minute in the rate year detail, hold on, let me grab that.
Thank you.
Yes, just confirmed in the work paper support.
Thank you.
Could we now turn to OCC 519? This is regarding dividends.
So we are there. I will just add that if this is a deeper dive into an analysis of dividends, equity infusion, we have our treasurer who will be on the panel. If preferred, we can have Mr. Kellen, who is with us here as well tomorrow, and he can speak to it during the revenue requirements panel at that time. He's also on the same panel as our assistant treasurer, Ms. O'Neill. They're on the same panel, but he will be here tomorrow, so he can answer this question.
I can try ask my questions and
Sure. I'll try to answer.
thank you, appreciate it. And just quickly, what was the information data request range here?
So, 1 second. Okay, so the information that we provided was from 2018 through 2024 in table 1.
And the request was for what data range?
The request was for January 1, 2013. We have been providing on this record anything that, any information that occurred since Yankee Gas's last base distribution rate case proceeding. And so we limited this to that period of time.
Thank you. The company was also asked to provide dividends Yankee Gas paid to Eversource. The company stated that Yankee Energy Systems, which is a holding company for Yankee Gas, paid dividends to Eversource. So just to make sure that I have it right, out of that 340 million, how much was Yankee Gas's share? Is that 100% of that attributable to Yankee Gas?
I missed that last part saying bless you to Mr. Pace. I'm so sorry.
Yeah, I'll repeat myself. So
The last part I missed, everything else I heard.
So out of that 340 million, just
Yes.
how much of that was Yankee Gas specifically? Because the company's response said that Yankee Energy Systems, which is a holding company for Yankee Gas, paid
That-
dividends to Eversource.
Actually, Mr. Zablowski, that is a transposition. So these dividends, thank you for that. These dividends are dividends that are paid. So the request asked for, since January 2013, provide the dividends paid from Yankee to Eversource. That's what that table is. So I apologize. That language has the E and the G transposed. So sorry, we didn't catch that. Now I was confused by your question. So if you look at that table, these are in table 1, dividends that were paid by Yankee Gas to its parent affiliated company, Yankee Energy Services Company.
Thank you. Makes sense. There doesn't seem to be, okay, hold on, let me back up. The company also claims a high percentage of retained earnings being reinvested into infrastructure. That response. It looks like there's no amount provided for 2023. And what does that NA signify?
I believe that the not applicable there identifies that there were the retained earnings because of the dividends that were paid, again, subject to check with Ms. O'Neill, Mr. Callan tomorrow. The not applicable states that looking at your financial statements and the movement of cash, the $112 million dividends paid in that year, and I believe there were equity infusions in the prior year that were almost as sizable, so unique when you look at the trend, so that dividends paid for that year that you're seeing there is likely, again, subject to check with our assistant treasurer and our investment planning team. The reason why it's not applicable is the retained earnings when looking at the financial data was a net zero.
Thank you. And is that same for 2018?
That is correct. Based on the financial data, it was zero.
Thank you. And the reason why I'm asking about those is because those 2 years are the years with the highest dividends paid out in this list. Would you agree that based on this list, in 2020 and 2021, Yankee paid more in dividends that then reinvested back into infrastructure?
Would I agree if 2020 and 2021? Based on the data and based on my understanding of your question? I believe so. So you're looking at 2020 and we have, correct, you're looking at 2020.
Yes,
Mr. Zabowski, okay,
Thank you.
yes, I would agree with that statement, yes.
thank you. Okay, could we please move to OCC 469? Hardship arrears.
So that was OCC 469?
Yes.
Okay.
Thank you. On the bottom of this response, the company stated that the purchased gas increase of 36% in 2022 through 2023. Hold on. That the purchased gas increased 36% in timeframe 2022 to 2023 compared to the 2018 through 2021. And also that the revenues increased year over year, and so then does the age hardship accounts receivable. So in a way, is the company saying that as ratepayers' bills increase, so will the customer arrears?
So revenue and accounts receivable are directly tied. So as subject to any sort of subsequent payment. So if year over year, in just taking 2023 to 2024, for example, I think the total revenues that were billed decreased about, I think, 92 million, close to $100 million. So as the revenues decrease year over year, and as those balances age out, if they do age out, typically we would expect to see a drop. May not be an exact percentage, but you would expect to see likely a drop in the uncollectible expense for hardship customers year over year.
Then wouldn't the company's proposed rate increase also going to result in a larger increase here? Would that be proportional? Does the company have that sort of a data or no?
When you say the proposed rate increase here, would we expect an increase in hardship costs as a result? Yeah, I think there's a number of different factors that we would expect to factor into the hardship uncollectibles. Number one, the COVID moratorium that was 4.5 years and ended last May has resulted in a significant material increase in the aged arrears compared to the pre-COVID time period. So just thinking through the propensity to pay model as customer balances are significantly higher as we sit here today in the hardship program than they were back in 2019 before the pandemic. The risk profile of the hardship population from a collection standpoint is fundamentally different. In addition to the impacts of the moratorium, which will extend beyond just the company being able to resume normal collection activities, we've also seen a significant increase in the number of hardship customers. In 2024 alone, I think that increase was for financial hardship customers was about 130%. And that was primarily due to the DSS match that was completed in May of 2024. And then there's also been some changes to the collection practices for reconnection of hardship customers when they are disconnected. And all three of those we expect to contribute to the increases and the sustained level of expenses that we've seen in recent years. And another, to your point in your question, increases in revenue can also have an impact to the increase in uncollectible expense as those balances age over time.
Thank you. Could we move on to OCC 452, attachment 1? Oh, sorry. Just let me know when you're there.
Yes, I'm there.
Okay, so line 18, this is overtime. O&M for Yankee Gas Direct. Though these costs fluctuated, it looks like overtime is about 20 to 25% of base labor. Would you say that 20 to 25% indicates a heavier reliance on overtime to meet operational needs?
I don't think I have the expertise to make that assumption now.
Okay. Fine. Line 20 then, base labor, capital and removal. There is a negative amount of 626,000 here. Can you shed some light on this change or adjustment? This is line 20 for column H 2023. The amount is negative. And then on line 23 for base labor, engineering and supervision, there seems to be an upward spike.
I think we can do a read. I do believe we may have responded to a question that addressed that shift between the two buckets, between the capital removal and the engineering and supervision. I don't have it right in front of me, so I think we could do a read-in. I don't want to hold up the line of questioning.
Read in BB.
Thank you. The allocated ESCO overtime as a percentage of labor looks to be like a much smaller percentage compared to Yankee Gas direct labor costs or Yankee Gas just generally. Is that primarily due to the nature of work performed at either Yankee or?
I think it would be the nature of work, but also the nature of the workforce. Many of the service company employees would be what we consider exempt from overtime, or they're not eligible for overtime compensation, whereas many of the Yankee Gas employees would be union-based, which would be what we refer to as non-exempt, so not exempt from overtime or eligible for overtime.
Thank you. OCC 428. This is insurance expense.
Could you repeat the reference, please?
Yes, it is OCC 428. This is regarding insurance expense.
Let me just pull that up. Okay, I'm there.
The company stated here that the general liability allocation changed for Yankee Gas in 2024, and this resulted in a lower cost to Yankee.
That is correct.
Okay. What is that based on? Which factors and formulas were changed?
So that's a very good question. In the process of pulling together the insurance expense for the rate case application, the company pulled the test year. And in order to adjust for any post-test year premium policy updates that we received, we did so all the way up and through filing. So any policies that were updated through October 31 of 2024, with the exception of one, we had all of them. So therefore, when we updated for general liability, this popped And we actually sat down with the with the insurance team and went through this, described it, and we included it as a pro forma adjustment into the rate year. So Yankee Gas was appropriately reduced for the rate year.
Yeah, I guess generally I was trying to understand how the premium is up 22%, but Yankee's costs are down 16% or so. I mean, I'm not complaining. I'm just trying to understand the methodology that allowed for this change, I guess.
So you're trying to understand the trend between test year and then rate year, because you see your test year profile. If you could show me where you are, Mr. Zablowski, I'll follow you.
1 second. So what I'm seeing is that the 2024 amount is approximately 1.501 million. Is that number still accurate?
I turned myself off. I'm sorry, where are you?
In OCC 428.
Okay.
Yep.
I'm there.
Okay.
Yep.
And I'm just wanted to check if that 1.501 million for 2024 is still accurate.
That is correct. Yes.
So essentially what we saw is insurance expense go down for Yankee due to
That's the exact.
an allocation, correct?
That is correct.
And then we see that amount going up again, correct?
Because of the escalation. That is correct.
The escalation. Okay, so that looks like a sizable increase here of about $400,000 or so. I think from that 1.5 to 1.895 million.
That's correct. Yes, the general liability was at the 22% escalation factor. That is correct. We just received cross asking us for supporting documentation on the escalation factors. So that 22% was used as the escalation factor once we adjusted the test year for that reduction. So that's why you're seeing that downward trend, like the trajectory is coming down significantly and then rising up.
Okay. And you said 22%, correct? The premium.
That is correct. Let me just grab my workbook and have it in front of me if you just electronically hold on.
I'll tell you where I'm going with this. So, because you said the
Sure.
premium is increasing 22%, but from 1.501 to 1.895 million, that's more than 22%. So there's something else obviously affecting that amount as well.
Yeah, and it's on the record. Let me just grab it.
Sure.
Let me recall it. We did walk through this. RRU 282. If you turn to RRU 282. And you go to attachment 1. Attachment 2.
Yes.
And you will see on line 18, as you indicated, the start shows an amount of, sorry, let me just make sure I'm looking at the right line here. On line 18, you will see 1858611. Then we have the interim period adjustment. That was the premium policy payment that was received with the supporting documentation and information provided, indicating that the allocation did change to Yankee Gas significantly. So Yankee Gas, the causal allocation methodology used by the insurance team changed because the policy exposure had shifted from gas had reduced in the gas area. So based on our discussion, what had occurred is in the late 2010s, I think it was in the 2017 period, there was a massive explosion that occurred in Massachusetts that essentially created premiums across the country increasing and exposure to risk increasing. There's some reduction now seen. The exposure to Yankee Gas and our gas business has now been reduced in terms of what I'll say is the portfolio exposure. I'm not explaining it as well as our insurance experts can, but when you're looking at a policy and you're trying to determine the companies that are being covered under that policy, you have to take into consideration the exposure. So at the time, the gas had more exposure. So the gas businesses had to pay for that exposure because it was gas operations and not electric. Now it has subsided, so the gas businesses have seen a reduction in their allocation as a result. So for 2024, when we received that came in as that approximately 430,000 reduction that was ascribed to Yankee Gas. Now, if you go into your column 1, 2, 3, 4 with data, and you look at your escalation factor, you'll see the 22% that was used from the insurance brokers and the experts. The policy is through March 31 of 2025. So keep in mind, we filed this in November of 2024, had this policy in hand, applied it. So that policy expired March 31 of 2025. And so we updated the information based on the actual costs in the policy. So we have reflected that through March 31 of 25.
Well, that makes sense to me. Taking the 22, dividing by 12 and multiplying through 19 for the months.
You got it. So you'll see there in the comment box, we escalated starting April 1, 2025, and we escalated that for 19 months through the end of the rate year.
Thank you.
You're welcome.
Thank you for walking me through that. Thanks so much. I just have one question on rent expense, real quick.
If you give me 1 minute to pull them up.
It's OCC 410 rent expense.
Almost there. Is there a specific attachment?
No, just the response itself.
Okay, thank you. Okay, I'm there.
So, quick question. Are the Waterford, Connecticut and Newtown, Connecticut locations owned by Eversource? The buildings themselves?
They are owned, 1 second, let me pull my other schedule, that's helpful. So the Waterford, Connecticut, and I believe you asked about the Newtown, Connecticut?
Yes.
Those are owned by Connecticut Light and Power.
So, reading this response, for the Westboro, Massachusetts location does not have intercompany leases, correct? But then when I look at Waterford, Connecticut and Newtown, Connecticut, there are intercompany leases here, whereas the Massachusetts one is an allocation based on.
Correct.
the accounting general ledger system on update regularly. Okay, as the response says,
Right.
is
Yep.
there a reason why that's the case? Or what would drive, having intercompany leases in one location versus in the others?
Yes, so that's a longstanding practice at Legacy Northeast Utilities, where these intercompany leases occurred. Legacy Northeast Utilities had a construct where the real estate and facilities, long time ago, were held by a real estate company. And so intercompany lease agreements made sense in that construct. So it's been a longstanding, I'll call it a policy of Legacy Northeast Utilities. Legacy N-Stars were owned by the operating companies, based on my understanding. So Westwood, for example, was owned by an operating company. So the intercompany leases, their longstanding tradition, and as approved by the Massachusetts DPU, was as long as they provided an appropriate mechanism to ensure there was no cross-subsidization, and the method in which they allocated the costs across the different companies that occupied the building, then that was acceptable for the Mass DPU.
So is the return profile, I guess, the same for both of these to the parent company?
So in terms of the return profile, I'm trying to understand your question. You're asking about the return associated with the facility asset itself? So CLMPs, I'm sorry, go ahead.
No, I'm trying to collect my thoughts here. I guess prior, in a conversation with PureSF prior, I think we were talking about the return component of the allocation in Massachusetts, for example. I guess I'm asking if there's any difference between having intercompany leases versus in allocating to Yankee, right? The difference between those two. I guess I'm trying to draw some distinction there, if there is any. We'd just like to
No, I
confirm that.
I think I understand what you're saying. Is there any distinction between the intercompany, what I'll call the transactional intercompany, to ensure that there's no cross subsidization under the legacy and Star policies, as opposed to the intercompany allocations under the legacy Northeast Utility lease agreement policy? What the answer is no. They're both based on ensuring that the cost of the facility building, lay down area, canopies, whatever equipment is being used where it's property, is ascribed to the operating companies, and the start of that is to ensure that all the costs to have that building in service. So typical sort of revenue requirement, rate of return, cost of service, that is all flowing through properly to all of the operating companies to ensure that all costs are recovered.
Thank you. And my last few questions, promise I'm being quick, are on work paper, Schedule C, work paper C-3.33, amortization expense deferred asset. And the accompanying pages 1 through 13 that follow, the tabs that follow.
Yep, I'm there.
Be faster than me.
I'm sorry, you didn't reference a question, right? Just C 3.33 in the associated work
Correct.
papers? Okay, thank you.
Okay. I was looking at the company's last rate case, and the company's ask included a 3-year amortization on most of its deferred assets, except for the merger costs to achieve, which was set at 10 years, I believe. This time around, the company seems to be proposing a 4-year amortization of deferred assets, again, except for the merger costs to achieve. Is that correct?
That's correct. The company was proposing to amortize the remaining balance over the remaining period as settled in docket number 180510.
Okay. I also looked at the final decision, in that docket, and the agreed upon amortization of these assets by settlement agreeing parties, settlement agreement parties seems to be 4 years for that final decision. Is that correct?
For all but the merger costs.
Correct.
Correct.
So would you agree that's 1 year, 1 year longer than the company originally proposed?
Oh, yes, yes, it's 1 year longer than the original proposal. The company, through the settlement agreement, made numerous changes to its initial application, and one of those was to extend the amortization but from 3 years to 4 years for those deferred assets, except for merger costs.
Thank you. So the amortization for the merger cost to achieve started in essentially 2019, I guess.
Yeah, it was November 15th of 2018 is when we started amortizing any balances that were authorized as part of that settlement agreement.
And so when the new rates from this proceeding go into effect, what would the balance be versus the company's proposed amortization, leftover amortization?
Specific to merger costs?
Yes.
1 minute. So we provided a schedule in, I believe it was RRU 269. So please, let me just pull that up so I can reference that. Yeah, so RRU 269 attachment 1, that provides a schedule of the previously authorized balances for each of the deferred assets, beginning with the balance as of 12/31/2018 and rolled forward through the rate year. What was the specific question? At what period of time were you asking about the balance for the merger costs? I can provide the reference to this.
Essentially upon the completion of this docket final decision, or where new rates will go into effect.
Yep, so when new rates are going into effect, so I believe it's page 1 of 1, row 78. And it would be column J in Excel. I don't think there's a column reference, but column J in Excel. The balance as of October 31st, 2025 would be $2,201,000.
Okay. So that's about 3 years of amortization left, correct?
That's correct.
Okay. If the company's proposing a 4-year rate plan, and there's 3 years of amortization left here, doesn't the company essentially get the 1 year or 765,000, I think that is, if I divide that through correctly?
Yes, please bear with me 1 second.
Yeah.
We did offer an interrogatory response, just trying to, it addresses that exact question. Okay, so that was in response to OCC 434. The question asked if the company does not file a rate case prior to November of 2028, confirm that the company will defer and return to ratepayers all amounts collected beyond the amount authorized. In that response, the company put forth its position on amortizations and the treatment of those amortizations through the 4-year period and also the period afterwards. Notwithstanding that discussion, the company did view the merger costs as a unique component of base distribution rates, so that PURA previously approved a discrete amount that was a result of a cost-benefit analysis. And to the extent those costs were to be continued to charge to customers, that could impact the cost-benefit analysis. So for this limited circumstance, the company did say we would commit under those limited circumstances to defer and return to ratepayers any amounts that were collected specific to merger costs amortizations beyond the amounts authorized in the last settlement agreement.
Okay, and is that dependent upon, a 4-year rate plan or no chance?
No, I think we're committing to any over collection of those costs, depending on whatever the result of this case is. The company would commit to defer those until its next rate case so that customers are made whole for that particular component. But once again, that's the company's position overall is that those amortizations are a part of total revenues that the company has to operate its business in between rate cases. And to the extent any amortizations would just naturally roll off, whether they be credits to customers or charges to customers, those would just still be part of the revenues the company has to operate its business. This is just a limited circumstance.
Thank you. And I think I can turn it off to Tony Wheel.
Hi, Tom Wheel again for OCC. I actually had a follow-up to that conversation, Mr. Murray. I understand the point of the testimony and the response to OCC 434, but wouldn't it be appropriate, given that the company is seeking a 4-year plan, to take the remaining 2.201 million and adjust the amortization expense to 4 years instead of the 765,000 or whatever it is now? I mean, I understand the concept of that the revenue requirement is the revenue requirement and that it all, but given that we're here and making known and measurable adjustments and purportedly trying to establish costs over a rate period, why wouldn't you just adjust the annual amount to 550, 250, which would be the remaining balance divided by 4 instead of 3?
Yeah, no, that's a great question. I don't think the company would be opposed to doing so. I think the company, when we initially put forth this proposal, was that we had a settlement agreement that agreed upon a 10-year recovery period. And I think by changing that, I would say we would try to avoid to change that. But I don't think we would be opposed to a 4-year recovery period so that it would end at the end of the proposed PBR term and align with that.
Understood. Thank you. And I do want to clarify, my question was more conceptual. I acknowledge the presence of the settlement is relevant, so thank you. My first question is about RU 218 attachment 2. This is the volunteer expense. I kind of started to ask this question of the payroll panel, the comp and benefits panel, and kind of shifted over here. My question's pretty basic, which is just that this shows, as I understand it, this is the breakout of the volunteer expense from the overall payroll expense. Shows the test year, but then these 2 other periods, this isn't the interim period and then the rate year. I'm not sure. I actually don't need to know why these particular periods are shown, but I was curious if the interim period expense and the projected rate year expense are somewhere else in the record. This is the end of the rate year.
So I think we were trying to show what the level of volunteer expense would be in the rate year, and I think that calculation gets you to that number, which would be the number on line 16. It's been escalated to $31,992. So that would be the amount theoretically in the rate year based on the test year value.
Okay. I guess I was just a little hung up on that middle number, like what the purpose of the April 1st, 2024 through March 31st, 2026. It just sort of seemed like it was like splitting the rate year in a way I didn't understand. But I guess I'll just ask to confirm, is the rate year number 31,992?
The rate year number would be 31,992, and the significance of those particular periods that you see on row 15 is due to the timing of the 3% merit increases that employees receive.
Okay, thank you. Moving on, I had some questions about the proposed energy assistance cost line item on bills. And I had some questions about uncollectibles generally. Starting, I guess, with reference to Schedule C 3.328 working paper, page 1.
You said C328, page 1.
C328 working paper, page 1, yes.
Okay, I think we have that.
Okay. So I just had some questions about understanding so there's the 6.305 is the actual bad debt expense in the test year, and that's only non-hardship. Am I correct?
That's correct.
Okay. And then I'm seeing the percentage of total billed revenues that was bad debt each year to derive that 1.1039% average uncollectible rate. So is that? One second. There I am. So that's just the average of the prior 3 years. Well, the test year and the prior 2 years average uncollectible rate as compared to the total revenue.
Yes, that is taking the uncollectible expense incurred in each of those years, dividing it by the total billed revenues for each of those years to determine a uncollectible percentage, and then averaging those 3 years, which equals the 1.1039 that you see in line 25.
Okay. And then on page 2, it's just applying that rate to the expected rate year revenue, and that's how the bad debt expense is collected.
Correct.
So with respect to non-hardship uncollectibles, there is none of the factors that you listed before, Mr. O'Brien, the moratorium, collections activities, none of that is factored into the expected rate year expense?
I don't think the moratorium was applicable and as long for the non-hardship customers. I believe the company has been able to pursue normal collection activities, I think dating back to September of 2021. So the moratorium that I referenced for hardship customers for 4.5 years, I believe ran from the beginning of the start of the winter moratorium in fiscal year 2019 through May of 2024. Additionally, I think some of those other statistics I referenced in terms of the significant increase we've seen in customers is not necessarily relevant to the non-hardship population, but I do think there are some changes in collection practices that may also be applicable to the non-hardship bucket. However, to factor that into this analysis is a really challenging exercise to estimate. So the company, in our estimation for the non-hardship uncollectibles, took the 3-year historical average to apply to the test year or the rate year revenues. I'm sorry.
Okay, thanks. Is the EAC going to be structured where there's contemporaneous recovery, like in each annual rate period? Is that the idea?
That was the idea.
Okay, so how are you going to determine the forecasted rate period level of hardship uncollectible expense? Like, what's that calculation going to be?
So I think from what we could use, if that was to roll into the EAC, and you're talking the hardship uncollectible expense, correct?
Yes.
So I think we could use a similar methodology to what we've used for the prospective period in the company's analysis. When we filed the rate proceeding in November of 2024, we used the average of the 3 previous historical periods. There's a very slight difference between fiscal year 2021 and fiscal year 2024. So if we had done a 3-year average as of the end of 24, it's virtually the same average of that period. And we are actually seeing in 2025 to date an increase in hardship costs through the month of April. We're currently closing the books for May. But I think a similar practice could be used in that initial period to at least estimate the level of hardship uncollectible costs we would expect for that first time period. And then obviously, if it's a recurring filing, we would continuously update that in the future.
Okay, so the forecast is really just for year one, because then in the second year and every subsequent year, you'd be using prior year actuals. Plus, if there's some reason to make a known and measurable adjustment, but then there'd be a reconciliation annually, right?
Yes, essentially that is what would happen.
Okay.
Attorney Will, can you just give me 1 minute?
Sure.
If you can just give us 1 minute.
Sure.
Okay, thank you. Thank you, Attorney Will.
Are you ready for me to keep going? Okay.
Yes.
So since the company's last rate case, were hardship on collectibles deferred? Is that the way that those were handled as opposed to being in base rates, or?
That is correct.
Okay. And the data for that's in Revenue Requirements Exhibit 4. Is that correct? YGS Rev Rec 4.
That's correct.
Okay.
And just one clarification, when you had referenced the treatment of the cost was that they were deferred. The treatment of the costs that they were actually recovered in base distribution rates, and to the extent there was any over or under collections, that would be deferred. So there was a level built into base distribution rates.
Oh, thank you. Okay, so this reflects the annual overage or potentially underage for what's in base distribution rates?
That's correct.
Okay. Thank you. I was just looking at that exhibit and just trying to get a sense of understanding the labeling here. Like, I see that there's amortization for MPP. Is that the like the arrearage forgiveness program costs?
I think that's correct for the matching payment program.
Okay, so is that a winding down asset that was allowed in the last rate case? Is that what's shown here? Like,
No,
I noticed that it's a
So I think both the hardship on collectible costs as well as the MPP costs were included collectively in docket 180510. And so the company is performing a similar measure for the MPP costs that we are for the uncollectible expenses, where we are tracking the level of MPP forgiveness against the amount that's being recovered in base distribution rates on a monthly basis.
okay. I see. So where it showed like the label amortize MPP, is that so for instance, like towards the beginning of the rate period, looking at December 2018, there's that repeating 397.55 number. Is that reflective of what's in base rates? Is that what that is?
Yes, I believe that's correct in the credit column.
Yep.
Yes.
Okay. Understood. And then for the monthly hardship reserve, I see that that's usually a debit, but sometimes a credit. So is that showing what we just talked about, that it's to the extent that it exceeds the level of base rates, it's a debit, and vice versa?
That would be more the actual on the uncollectible side.
Yep. Well,
Yeah, that would be more arrearage activity. So month to month, if there is, let's say you have a level of arrears, That's $10 in the subsequent month. Customers make payment, that drops to $8, and that was previously recognized as an uncollectible expense. There would be a credit that would flow through that
Okay.
balance. So that's what that should be reflective of.
Okay. So does this show the annual true up between base rates and actuals for uncollectibles?
There's not.
And sorry, by true up, I meant the deferral that we were discussing before, the difference between the base rate level and what's being deferred.
Yeah, so I think it would be the total amount of, it would be the debits minus the credits in each of those columns for each individual month, which would get you your over under recovery in that given time period.
Okay. Thank you. And I noticed you might not need to pull up the schedule because it's sort of more of a conceptual question, but I was looking at schedule B6.1, which is the amortization with actually the deferrals in rate base, and seeing that the value of the deferral related to this, I think, reducing. I guess my conceptual question is just that the proposal isn't to continue deferring these costs on an ongoing basis because they'd be recovered in the EAC instead.
That is correct. For prospective amounts, we were wanted to include that in the EAC.
Okay. Thank you. My next questions were generally about Schedule C 3.32. Which is the ESCO depreciation expense.
I'm their attorney, Will.
My general question is, what is being depreciated here the property that's shown in Schedule H13? Is that the same? Like, if I wanted to get a sense of like what's driving this depreciation expense in terms, as you've discussed, Mr. Peruta, this is similar to a revenue requirement, right? So like, I'm trying to get a sense of like what's the rate base that's being depreciated here.
That's correct.
Okay, so H13, which is the listing of the ESCO level properties.
That's correct. It's within the FERC Form 60 for Eversource Energy Service Company.
Okay. Thank you. And is that the same rate base that's, if you want to call it that, that's driving the rate of return cost that's been exhaustively discussed today? The proportion of the allocation of allocation from ESCO to Yankee that is the return component of rate base.
So this workbook specifically, this work paper, excuse me, your C 3.32.
Is depreciation.
That is just the depreciation expense. I know you asked me this question on Friday when I was at the podium. The portion that relates to the return associated with the assets of ESCO are sitting at C-3.14.
Yep.
So I'm sorry if that wasn't your question.
The question was just the same question I asked before about depreciation. Is the rate base that the return is being earned on? Is that the Schedule H1.3 also?
Yes, correct. Your holistic view of Eversource Energy Service Company is what develops the cost of service that's being allocated out to all the operating companies. You're absolutely right.
Okay.
It's your baseline is Eversource Energy Service Company, FERC Form 60.
Gotcha. Mr. Bakari was asking some questions about OCC 462 Attachment 1, which you also might not need to open. The line of questioning was about how the rate of return on equity is derived, and I followed that and understood it. My question was just is whether the cost of debt is derived the same way. Like, is it the authorized cost of debt for every operating entity, like flowing to a similar average as the cost of equity?
No, that's actually a very good question. On the cost of debt piece, the portion that's being sought to be recovered by Eversource Energy Service Company is the short-term debt and long-term debt that is sitting at Eversource Energy Service Company. That is the capital necessary to maintain, build, maintain, upgrade the infrastructure.
Gotcha. Okay. And is that calculated the same way as, again, like a revenue report? Like that's looking at the actual sort of debt portfolio of Eversource Energy, and there's an average derived, there's the return on debt, the rate, the debt rate, is that derived from like averaging out the individual rates of each kind of debt instrument in the portfolio?
So it's using the individual interest rates throughout the debt portfolio, but it's actually a little bit more precise because it's pulling your interest expense on a monthly basis.
Okay.
There's no weighing. So if you look at what's on the file right now, I'll stop there if I've answered your question.
Yep.
Okay.
That I get it. Thank you. I had some questions going back, I guess, to the EAC mechanism. And I'm sorry if I missed in the testimony, but what's the company's vision of like when, like what proceeding or when the reconciliation would take place? Would that be like in the, like on the electric side, that would happen in the RAM, which is this annual proceeding that's sort of established, but we don't have really something similar on the gas side. So I was just curious, like what the idea would be there.
Yeah, I think a process would have to be started for that, but I do think that it would be an annual reconciliation similar to the RAM, except in this case for the gas company.
Okay. Thank you. In the RAM, I think this panel might be familiar with this issue on the electric side, because the company accounts for costs and revenues on a calendar year basis, but the RAM adjustments are made for a sort of a RAM rate period basis. There is, this is being discussed in an open docket separately, but that results in some confusion and it has an impact can have an impact on under recoveries and associated carrying costs. Does the company have a view of how to treat that potentially differently for the EAC, or has the company thought that through?
I think we would defer to whatever process Pura wanted to initiate for that, but I think we would want to try to keep things based on a calendar year basis, and if that requires projections, then that would be workable for us.
Okay. Thank you. I had some questions about the Northeast Gas Association and the associated mutual aid expense. Attorney Keenan also stole all my questions there, so I just have a couple left. I think Attorney Keenan had asked earlier whether any portion of that expense was used for lobbying, and the panel wasn't aware. Could you remind me of what the answer to that question was?
Okay, so while after that question came up, we went back to ask the SMEs back in Berlin if they knew more about lobbying activities that NGA might be involved in. They reached out to Northeast Gas Association, and their response to us was they no longer engage in any lobbying activities.
Okay. Is the panel aware of whether NGA was a registered lobbyist in New York during the test year in 2023?
I am not aware of that.
Okay. Do you have any awareness of their lobbyist registration in Massachusetts at all?
No.
Thank you. Attorney Keenan also asked as I recall, if the company could engage in mutual aid if it weren't a member of the NGA. And I think I recall that the answer was that someone from operations would be better to respond to that. I just wanted to confirm, would that be a question for the capital planning panel?
I think it would be better suited. We did get a response. I can attempt to answer that if you'd like. That's from our operations folks. So their understanding is that you would have to contract separately with those organizations. It's just the same way as you can make any legal contract. We could do that. They said with the membership, we no longer have to contract with each company separately.
Okay. Thank you. So, RRU 359, which was discussed earlier, discusses this expense and references mutual aid events in 2018 and 2019 that I can pull it up, but I think the scenario there was that Yankee provided mutual aid in each of those years. My question is whether I'm familiar with like the normal, not normal, I'm familiar with other mutual aid arrangements where there can be revenue to a company. Like if a company provides mutual aid to another company, the other company has to pay for it. So there's revenue, and then there's also expense driven on a sort of per event basis. Does this membership fee like eliminate that? Like, is this just like a flat fee to be a member of the NGA, and then there is no kind of cost or revenue one way or the other per mutual aid event?
I think the membership just gives us access to mutual aid resources from other utilities. If there was an event, there would then be a billing involved in that event.
Okay, thank you. And I think my last question on this is just referencing Schedule 3.23 working paper. Or maybe it's just Schedule 3. Yep, working paper. So I'll wait till everyone has it up.
I have that.
Okay, so I see that the title of this schedule is mutual aid dues, and I see that the only expense that is in the rate year is the Northeast Gas Association we've been discussing, but it also shows AGA, Advanced Connecticut, Metro Hartford Regional Economic Alliance, Chamber of Commerce Connecticut, Connecticut Business and Industry Association, and other allocated membership. Are all of those also related to mutual aid?
No, they are not. So in the prior rate case, I believe this schedule had a different name. I think it might have been industry dues or industry and associate. I forget what exactly the prior name was. But because we knew we were pro-forming out all of those other industry dues or association dues, we wanted to change the name of the schedule so that it reflected what would be remaining in the rate year, which is just the NGA dues, which is for the purpose of accessing mutual aid.
Okay, understood. Thank you. My last set of questions is about payroll, but specifically the payroll, kind of a broader view of payroll than what I asked the comp and benefits panel. So on page 66 of the testimony, the original revenue requirements testimony, there's just a table there showing the known and measurable adjustments to the test year. And I noticed that payroll is by far the single biggest known and measurable adjustment, correct?
That's correct.
Okay. And on Schedule C37, working paper, page 2,
Yep, I'm there.
okay, thanks. It looks like about 52% of the total rate year payroll expense, which is the 52.321 million, is under Eversource rather than Yankee. Is that right?
Can you repeat the numbers? I'm sorry.
Sure. I just added up the payroll that's I just added the total in row 44, which is the allocation to ESCO, to the total sorry, I didn't add them. I was comparing the total Yankee payroll versus the total ESCO payroll. And Sorry, did you?
No, I'm sorry. I just wanted to make sure I was referencing. So I'm on late file 1, supplement 1, which is
Oh.
the latest
Oh,
cost of service, or
I'm looking at the original C schedule. I'm not sure whether it's changed. My question was just whether the majority of the total payroll expense is for ESCO as opposed to Yankee.
so in the latest cost of service, which is late file 1, supplement 1, at the end of the title, revision 2, we're calling it. The service company, the ESCO payroll expense allocated Yankee Gas represents approximately 51.5% of the total expense for rate year 1.
Okay. Thank you. I was looking at the same schedule C37 that was filed in docket 180510 to get a sense of like the difference between the sort of what the schedule looked like in the last rate case and now. And I was specifically looking at the rate year 3 total payroll from that schedule, subject to check. I'm not sure you have it in front of you, but
I was going to say, if the witness doesn't have the evidence in front of him, he may not be able to respond. He can try, but if he can't respond, maybe we can take a late file on it. You can go ahead and ask the question.
sure. The question is just that the rate year 3 total payroll was 40.425 million. Would you accept that subject to check?
Yeah, I don't have that in front of me. Subject to check, sure.
Okay. I think maybe in the interest of time, especially for today, if I could just ask for that schedule C.37 filed in 180510 as a late file, and then I can just ask all these questions while we have the exhibit in front of us, if that works for the company.
Is that late file 84?
It is Attorney Pace 84.
And as long as everyone's got that, that was my last question for this panel, and Mr. Sobolewski has some questions as well.
Good afternoon, Richard Sobolewski for the Office of Consumer Counsel. I have just one area across, and it's on the company's non-firm margin. In the revenue requirements testimony, I think it's starting on page 62. There's some discussion of settlement from, I think it was one of the appeals from the system expansion plan. My understanding is that the proposal that the company has is that in this rate proceeding, there's no inclusion of non-firm margin. Is that correct?
Yes, that is correct.
What the company is proposing is that the non-firm margin that was deferred from April 27th, 2022 through December 31st, 2023 be returned through a future PGA. Is that correct?
Yes, that is also correct. Those non-firm margins were generated from PGA expense, well, from PGA pipeline capacity. And so, yes, we think that should go back through the PGA.
That amount that's referenced in the testimony, $37,364,053, does that include any carrying costs or not?
It does not.
Okay. The proposal that the company has here, do you know if that's consistent with the treatment that was awarded CNG and SCG in their recent rate case?
Based on our understanding of the decision, we believe that is correct, that was approved in the CNG and SCG rate case subject to check.
Okay. the other non-firm margin post the end of calendar year 2023, that's going back through the PGA currently, is that correct? The annual basis, like it did prior to the system expansion plan, is that correct?
Correct. It is being flowed back through the PGA at the same percentages that were prior to the initiation of the gas expansion plan, which is 99% to customers and 1% to the company.
Now, I'd like to ask for a late file exhibit. Because my understanding of the CNG in Southern case is a little different. In that case, it's my understanding that the company, Pura ordered that a certain balance be returned over a 3-year period with carrying charges. Okay, so what I'd like to ask is if you could take that 37 million and add carrying charges at your last allowed weighted cost of capital and amortize it over a 3-year period, starting with the start of your rate year 1. And could you just show what that would be on an annual basis for the 3 rate years?
Yes, we can do that.
And the only piece we would add would be that there was a settlement of an appeal that resulted in this issue being raised in this case. And so we'd provide the company's perspective on that and the data and the late file also. Thank you.
Okay, that's late file exhibit 85.
Thank you, that's all I have.
And that's all OCC has. Thank you very much.
Thank you. EOE. Question. Attorney General? Oh, you do have question? Do not. Okay, sorry. Attorney General? Thank you. Commissioner Karen?
No question.
Okay, just have 2 quick questions, I think. I just want to make sure I understood the testimony from just a few moments ago, Mr. Shelnitz, about whether the NGA engages in lobbying or not. I think I missed the first part of your testimony. So I guess my question is, do you have any personal knowledge as to whether NGA engages in lobbying currently or engaged in lobbying during the test year?
I'm sorry, I do not have any personal knowledge, but we had someone back at the office reach out to the NGA president, and they said that they don't do lobbying anymore and don't pay lobbying costs.
Thank you. I'll move on. I have a question about really going back in the archives here. I have a question about something that happened in docket number 10-1202, but it's referenced in this panel's testimony, Brev Rec 1 on page 131 to 132. I think the question actually pertains to the PGA, so I'm not sure if the question's better for the rates panel or the revenue requirements panel, so I'm just gonna give it a go here.
Sure, Madam Chair.
Thank you. Okay, so I got a little lost in trying to review the company's position, which starts on, actually, I'm sorry, I think it starts on page 131, where you're referencing back to the authority's decision from docket number 10-1202. I understood the company to be essentially arguing that there is not an adjustment, and they're pointing to and starting at line 28 of page 132, a sentence from the company's brief. It's highlighted, or it's underlined and bolded. Do you see that? It starts, the company misses the point.
That is correct.
Okay. So I actually went back and pulled that brief that is referenced. And there's a footnote in that brief that states, it's the company's brief. As Mr. Bauman testified at the hearing, the 2008 accounting change initially resulted in a one-time $2.7 million under recovery for Yankee and its PGA reconciliation. That amount was thereafter recovered from customers, is now gone. So I think what I'm struggling to reconcile is has the company changed its position from its brief as to whether that constituted an adjustment?
No, Madam Chair. What the company has done is, because the company continues to struggle with that decision because it is inaccurately developing a lead lag study that is not appropriately reflecting the purchase gas, we have put more evidence on the record. And if I could just quickly take you to a response, or I'll stop there and.
No, please take me to their response.
Okay. Okay, thank you for your patience, Madam Chair. RRU 363, I thought was a great question. The company laid out, and I think did a really good job based on the question that was asked, to determine precisely how we would treat a customer's revenue. So if you look at how we described it, and I'll read section B. From a cash working capital basis, from a cash working capital perspective, if hypothetically the company has only one customer and that company is billed on August 1, 2023 for service provided from July 1 to July 1, from July 1 through July 1 of 2023. So you have 1 month. Let me just take off my reading glasses. I can't see you. Sorry. So if you have a service period for the entire month of July, much better, thank you. And the customer is billed on August 1 of 2023, that means that the customer was likely billed August 1, 2023, and the customer will send their cash payment to Yankee Gas on August 31 of 2023. The reason that is when you look at our revenue lag and you look at the entirety of the year, that is the lag based on collectibles, just collectibles. The average customer has a lag of about 30 days in paying the company. So they receive the bill, and on average, some customers pay earlier, some customers pay later. But of course, as we all know, if you pay later, you get a late payment fee. So there's some incentive for customers to pay within the allotted time. So the collection lag is roughly 30 days, okay? If you go to the next page, I just hope you all are with me. I'll walk slow. The cash received on August 31, 2023, in the example Pura requested me to put in here, would be used to pay natural gas suppliers who submitted their invoice after August 31, 2023. Cash comes in, I hold it. The next time I get a bill, that cash is for my purchased gas that I serve that customer. So I'm going to get that cash on August 31. The next bill I get is what I'm going to pay with that cash. So the next bill that I get from my suppliers, based on the lead lag study, Eversource, and we did a full analysis on every single bill for every single supplier. And when you look at all of the natural gas suppliers at Yankee Gas that were received in 2023, those invoices that were received after August 31, 2023, so I have that cash, were for services provided, gas costs incurred from August 1 to August 31 of 2023. Does that make sense so far?
Yes.
Excellent. Okay. So the first payment date for that supplier who supplied me the gas for that customer would be September 8th, 2023.
Mhm.
Does that make sense? So that's the cash
Following you.
outflow. So the company's position is that the actual cash that's received from the customer when I am giving that customer that service during that 30-day period in July, right? I'm gonna get that cash in and it's gonna be delayed. So that cash, I'm not gonna get till August 31st. I'm out of the money.
Mhm.
Do you see that? When I pay my purchase gas for that July, I'm paying it pretty much right after that. Do you see how I have not received the cash? I have a lag. Immediately, it's 10 days. Because that July service period, I paid that bill in August. I did not receive that cash until September 8th. So I can't pay my supplier without borrowing. And that is the cash working capital. And
Understood.
that's 10 days.
Understood. Thank you. Okay, let me just double check. I think those were my two questions. Mm. Okay, I think we're all set. So I'll ask the company if you need a recess to consider redirect.
We will need a recess, and I will have redirect examination for the panel if I could. And I realize it's been a long day for the commissioners, and I appreciate your time and attention. If I could have at least maybe 7 or 8 minutes to speak with my panel, because we have, I'd say maybe 6 to 7 hours of cross-examination. I just want to make sure I cover some key points with them outside in the hallway before I come back for redirect.
Sure, we'll just put a certainty. We'll recess until 5 p.m.
Thank you.
Attorney Tisdale, when you're ready.
Yes, thank you, Madam Chairman. The company does have read and tea available at this time. Mr. O'Brien, can you provide the response?
So Reed and T was asking about the company's FERC Form 2 for 2024, and if that was in the record yet. Given that was just recently filed, I don't think that's in the record. So if the authority staff would like that as a late file, we could certainly provide that.
Okay, thank you. So I'll convert that to late file exhibit 86 is to provide the most recent FERC Form 2, please.
Okay, and I do have some redirect examination for the witness panel. I'm going to start first with Mr. Dykeman and Mr. Horton. Do you recall the questions you received earlier today that dealt with contracts and purchase orders to support the service costs that the company has reflected in the case? Do you recall that exchange?
Yes.
And can you provide more detail in terms of the context about how we determine escalators for those particular types of services referred to in that line of questioning?
Yeah, a lot of our contracts are multi-year contracts. And because there's typically volatility in a number of factors from raw materials to labor costs, market volatility around commodities. In many of our contracts, we will cite an index, and that index gives us both upside and downside protection, right? Because if you ask for a fixed cost, typically vendors are going to carry any risk in the fixed costs associated with their contract. So in many of our contracts, we have those types of indices in there to protect ourselves from that volatility. So it gives us protection both on the upside and on the downside. And that's a tactic we've used for many years. The agents responsible for those commodities will obviously work directly with the vendors, adjust prices accordingly. And when the purchase orders actually get cut for that specific purchase, it will reflect whatever the most recent pricing is based on whatever the index is. Could be the CPI, could be PPI, could be anything around, great example in the gas business is asphalt cost, right? Because asphalt cost is tied directly to the cost of diesel fuel and other materials that it takes. So, that's how we protect ourselves. But again, it's both ways. So it could actually protect us from a downside as well as from an upside.
Thank you. A follow-up question would be, again, that line of inquiry had just focused on services for which the company seeks to receive reimbursement plus adjustments for the upcoming rate year. Mr. Horton, can you add to that explanation in terms of the impact of inflation?
Thank you. And just briefly, what we're attempting to do in our cost of service filing is compile all the costs that we incurred in the test year and then making adjustments either based on, explicit known and measurable contractual changes, or in the event there's not an explicit known and measurable adjustment. Generally, regulators allow for an inflation adjustment on a residual expense amount, which we endeavor to make as small as possible. But that's really just to the point that Mr. Dykeman was just making, that for all of our costs, we either have a contract or we have a purchase order. There are inflation elements built into either. But just the fact that there isn't a contract associated with every charge isn't necessarily indicative of anything. The example we were talking about on a break is, a town invoicing us for paving or for details, excuse me. We're not going to have a contract. We're just going to be paying the costs that are invoiced to us as a charge for that invoicing detail. And so as we're preparing the schedule, we go through and provide, as I said, all the explicit details that we can. But there's inevitably, in every rate case that I've been involved with, a portion of our O&M expense that is just subject to inflationary measures. And our attempt to apply the GDPPI as an inflation factor is, as Mr. Dykeman said, to get to a representative level in the rate year. And just briefly on that, I really appreciate the in-depth discussions that we received today. I know it can be painful for the questioners, and there's a lot of information to work through. We do our best to respond to them in discovery, and as the revenue requirements panel, we certainly try, because we have to cast such a wide net, to go as deep as we possibly can. I just want to say that we do genuinely appreciate the questions. It's impossible for us to anticipate all the questions that could come our way. But again, I just really appreciate the in-depth review, and I'm grateful for the questions that were received in order to be able to be responsive as possible.
And so, Mr. Horton, the example you gave was, for example, there are some situations where there's no contract, and you offered an example of a town charging us a fee for permits or police patrol, correct?
Correct.
And Mr. Horton, if Pura were to conclude in their rate case decision that because we had no contract to support a particular cost of doing business, and they would not allow for an inflation adjustment, would that then reflect our actual cost of doing business for the forthcoming rate year?
No, it wouldn't, because, just the fact that there does not exist to have a contract associated with the charge doesn't mean that the charge isn't necessary. Like I said, if you take that example, we obviously, as a gas utility, have to incur costs associated with details when we have to open up a road and repave it. The fact that we don't have a contract with every town doesn't indicate any, lack of prudent management of cost controls, both in terms of the inflation adjustment or in terms of the underlying cost itself.
Okay, thank you. I'm going to move on to another line of redirect that I have. And this redirect is directed toward Ms. Peruta. Ms. Peruta, do you recall earlier today you received questions regarding OCC 519?
I do.
Okay. And do you recall that the question there dealt with the question of dividends compared to amount invested for calendar year 2020?
Yes.
Is there any additional information you'd like to offer to provide context on the response you gave?
I would. OCC 519 and OCC 518 really should be looked at collectively. The OCC 519 is just one side of the story. The dividends paid that are seen in Table 1 in OCC 519 that we walked through should and will always be compared to your equity infusions that are coming from your parent company. So if you go to OCC 518 Attachment 1, and here in this schedule, you have the Yankee Energy Services equity infusions down to Yankee Gas. Now, when you take both of those sets of data points for any given year, in the years presented cumulatively, we have had more equity infusions down to Yankee Gas than Yankee Gas's dividend distributions up to Yankee Energy Services system. And then if you look on any given year individually, there were questions related to 2019, I think it was 2020 and 2021. And when you look at the equity infusions that were paid in those years, we are at 50 million in 2020, which is in excess of the dividends. And in 2021, we were at 123.4 million as compared to the dividends paid up of 41.2 million.
Okay, and so as a result of that additional information you put into the record, it's not true that the company paid more in dividends compared to amounts invested, correct?
Yes, that is correct.
Okay, thank you. My final line of redirect examination is also directed to Ms. Peruta. Ms. Peruta, do you recall a line of inquiry you received earlier today regarding RRU 282 involving insurance policies?
I do.
And will we have permission from the chair to have Ms. Peruta file the actual invoices? She received questions about cost relating to insurance, and RRU 282 would like to actually provide the supporting documentation to the authority to have that in the record and be able to answer questions on that. Would we have permission to supplement an existing late file to give the actual invoices that were discussed when there was an exchange of questions over RRU 282? And we could take a new late file or work that into an existing one, whatever works best for the authority. But again, the goal is to be responsive to the good questions we received and to ensure that we get the evidence in the record to take further questions if necessary.
I'm sorry, one moment. I'm just trying to catch up. You said RRU.
I believe it was RRU 282, and Ms. Peruta can correct me if I'm wrong.
That is correct, Attorney Pace. It is RRU 282, Attachment 2, Madam Chair.
And what I can offer would be, for example, we do have an existing late file exhibit 69 that asked for insurance, albeit not that specific one. We'd be happy to work that into as a Part B and refer to the data response RRU 282 and provide the supporting information that was discussed in the line of questions.
I'm sorry, you said late file exhibit 69?
Correct.
I thought late file exhibit 69 was about the ERISA lawsuit.
What I have for late file 69 is the explanation of how the class action lawsuit increased insurance expense for the company. And since it does deal with insurance, that might be one option to be able to work it in there, but we're also happy to take a brand new late file if that works better for the authority and the parties.
Okay, I'm looking at the late files and what we requested, and I believe our questions were asked and answered. But so,
What I would then request permission, and the alternative would be that because the company does have an ability to be able to offer evidence and we have the burden of proof, we would request latitude to be able to sponsor a late file to ensure that we can put information into the record while the contested case is open and then produce a witness at the late file hearing who's able to answer questions on it, if we'd have permission to do so.
okay. I apologize. I'm trying to look back through my notes on this, which are not here. Okay, let's go ahead and take that as a late file. I don't want to confuse the earlier one. So it's going to be a late file exhibit 87, I believe
86,
we're up.
87, thank you.
87 we're up to. So you're going to provide,
We would provide the actual invoices to supplement the record to support the insurance expense that's shown in RRU 282. Thank you, Chairman.
okay, thank you. Anything further?
I was going to consult with my colleague, Attorney Tisler. That completes our redirect examination for the panel. Thank you, Commissioners.
Thank you. Then my thanks to the panel. We'll excuse this panel request that the OCC bring up its witness for its revenue requirement panel so that we can proceed to adopt the materials. Attorney Wheel.
Thank you, Chairman. This is John DeFever of Larkin and Associates, our revenue requirements consultant in this case.
Thank you. Attorney Mr. DeFever, can you please raise your right hand? I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you, Attorney Wheel.
Mr. DeFever, did you sponsor pre-filed testimony, rebuttal testimony, and interrogatory responses in this proceeding?
Yes.
Do you have any changes or additions to those filings?
No.
Do you adopt those filings as your sworn testimony today?
Yes.
With that, I think the witness has adopted his testimony and is open to any questions from the commission or anyone else. Thank you.
Thank you. I'm confirming that the company has waived. Thank you. None from authority staff. EOE. Thank you. Attorney General. Thank you. I have no questions. Mr. DeFever, you are excused. Thank you.
Thank you.
Okay. Do we want to give this a go with the OCC's rate panel?
Yes, Mr. Nelson is here. We could at least swear him in. It's my understanding the authority has crossed, and that might be the only cross there. So we're certainly open to it.
Okay, and I'm just going to proceed because I believe I'll allow, if Attorney Pace or Attorney Tisler want to correct me, I believe the company has consented to taking the OCC rate design panel out of order. Yes, thank you. So let's summon Mr. Nelson. Thank you. I'll ask authority staff to approach. Attorney Wheel.
Thank you. This is Ron Nelson, our consultant for rate design in this proceeding.
Thank you. Mr. Nelson, please raise your right hand. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury. Thank you. Attorney Wheel.
Mr. Nelson, did you sponsor pre-filed testimony, rebuttal testimony, and interrogatory responses in this proceeding?
I did.
Do you have any changes or additions to any of those filings? Do you adopt those filings as your sworn testimony today?
I do.
And with that, the witness is prepared for cross. Thank you.
Thank you. Authority staff, please.
Good afternoon. My name is Pat Fryer. I'm one of the staff attorneys here at the authority. And I have a couple of questions for you. Hopefully these will go quickly. So I'd like to refer you to your pre-filed testimony at page 9. And reviewing that, it appears that you mentioned the company's sample size between 6 to 18 observations is too small to represent the broader population. Am I reading that correctly?
I believe so.
And what would you consider to be a suitable sample size to represent the population?
Well, the issue goes deeper than the sample size because the raw data for this analysis is around 9,000 observations. And then those observations are averaged into the sample size that's used for the regression. That step right there is really not, in my opinion, theoretically correct, right? You're taking a data set that is nonlinear, and then you're averaging it to create what you're calling a linear relationship with data. So you kind of have to take a step backwards and look at the raw data and say, before we even start, is this the right methodology to be using for what we're trying to achieve? To go back to your, the sample size question, a rule of thumb that's used in some statistics is 30, but usually you have a statistical test that you can test the power of the sample size compared to the population. And I didn't see any statistical tests around on the sample size.
Are you familiar with the student's t-distribution and t-test design for small sample size?
I mean, I have reviewed it a long time ago.
Have I'd like to refer you to your pre-filed testimony on page 12. You described the zero intercept method as inaccurate and biased. I was wondering if you can explain why you considered or made those considerations in your pre-filed testimony.
Well, so first of all, you are specifying the equation as with the dependent variable being the diameter of the pipe. So you've got unit costs equals the intercept times the plus the coefficient times the diameter. And so that simplifies to, demand influencing unit cost. The issue with that is pressure is also a correlated to unit cost potentially, and is related to demand. So in theory, you would include a pressure variable in the specification of the equation. And if you eliminate a variable that would be used to predict your Y, you bias the equation. So that's one example.
Do you have any others or?
Well, I think I just gave you kind of another one at the beginning where you're taking raw data. The whole reason you're running this regression is to evaluate the variance of the observations. So you have an estimate and then that is your line. And what you're doing is you're creating an estimate that minimizes the errors associated with your observations. And when you average all the raw data, you're essentially eliminating all the variance, which doesn't make a lot of sense because the whole objective is to look at the variance and try to minimize it. Minimize the errors associated with your estimate. The other issue is that again, kind of already touched on, is that this isn't a linear equation if you're looking at the data, right? The data, if you plot all the raw data, you're going to have, for example, for a 4-inch diameter, you're going to have dots stacked right on top of each other if you're graphing it with your Y and your X. That's not linear. A linear equation cannot have in X, when you put in your X equals 2, Y can't equal numerous things at the same time. That's not a linear function. So it's not specified correctly when you're looking at it from the raw data perspective. So again, that would bias how you're estimating the coefficients within the regression.
Under the basic customer method, is it fair to say that most costs are allocated on a demand basis instead of on a customer basis, unlike the minimum intercept cost methodology?
Specifically, the mains are allocated on a demand basis.
Is it correct to say that in applying the basic customer method, that because of the contribution to demand versus customer count, more costs are being allocated to commercial class customers and less to residential customers?
It depends on the cost allocators. In this instance, it would.
And is the basic customer method biased because the cost allocation is favorable to the residential customer classes, as it allocates more costs based on demand than the number of customers in each rate class?
It just is, it's a different perspective on cost causation. Several commissions use the basic customer method in different states.
And on moving to page 21 of your pre-filed testimony, on line 15, you state that the increased demand would likely increase system demand requirements. What do you mean by increased system demand requirements?
Sorry, can you?
Page, do you want the page number again, or?
Okay. Additionally, the increased demand would likely increase system demand requirements. That is a sentence. 1 second. Okay, here I'm talking about the price elasticity of demand. So the price elasticity of demand is looking at total therm increases. So it's a throughput concept as opposed to a demand concept. However, throughput and demand are correlated. So that's what that sentence is addressing.
Can you confirm that the pricing elasticity example is theoretical and that the short run price elasticity factor is assumed? Is that correct?
The numbers used are directly from Yankee's proposed rates. The price elasticity of demand, I used a range in the work paper, and it is assumed. However, it would be against economic theory to assume that there is no price elasticity of demand, or that it is not that it does not increase consumption when you lower price, marginal price.
On page 23, can you, from your pre-filed testimony, can you identify the states that comprise the Northeast region for the residential energy consumption survey?
As I sit here, I cannot tell you the exact states that are in that. No. I apologize for not including a reference there.
Can we get a read-in on that? Or considering the lead file, probably.
I would say we could do a read-in if it weren't 5:27 PM, and frankly, if we weren't trying to get Mr. Nelson home tomorrow. So a late file might make more sense.
And that late file would be to identify the states that comprise the Northeast region for the residential energy consumption survey.
Okay, and that is late file exhibit 88.
And I have 3 more questions. Well, 3 with some subparts, so hopefully I'll get them through quickly. Do you know whether the survey data in table 5 distinguishes such factors as the size, like square footage, or age of the residents, or is it all the data combined regardless of these factors?
I'm sorry, I didn't catch the end of that question.
Or is it all the data combined regardless of these factors?
I would have to review the methodology to be able to answer that.
Would we like that addressed in late file exhibit 88?
Yes.
If it's helpful in late file exhibit 88, we can provide a narrative response to the initial question and then also provide whatever documentation there is behind it if that's helpful to the authority, which I presume might address that last question.
That'll work.
Thank you.
And are you aware of any Connecticut specific survey data?
Can you be a little bit more specific, Connecticut specific survey data on?
Well, referring back to the residential energy consumption survey.
I am not aware.
On page 19 of your pre-filed testimony, you discuss a $59 cost that you estimated for residential heating, for the residential heating customer class. In your opinion, would those estimated costs apply to the residential non-heating customers?
Sorry, I didn't see that.
Would those costs apply to the residential non-heating customers?
It wouldn't be exactly the same, but it would be, well, I'd have to check to know exactly what it wouldn't be exactly the same. I don't know exactly what it would be.
And on page 6 of your testimony, are there instances or circumstances where it is appropriate to remove data from a sample size as an outlier in a study?
Can you repeat that question, please?
Sorry. It was just, let me just clear the record. It was in your SIR rebuttal at page 6. And I'm looking to know, are there instances or circumstances where it's appropriate to remove data from the sample size as an outlier in a study?
So the company didn't remove outliers from its raw data. It averaged the data and then removed an outlier and then called it an outlier and removed it. So you would be looking at the raw data if you wanted to remove outliers. And you would have some reasoned judgment and methodology that you would be using to identify outliers. And then usually you would potentially look at what the results were with and without the outlier.
So is it ever appropriate to remove certain data?
There's always going to be a circumstance, data entry errors occur. That seems to be what happened with the companies, but then they didn't correct the data entry error. My assumption is that the 5-inch pipe was supposed to be 0.5. If they would have corrected it and done 0.5, it could have changed the regression of results pretty substantially.
That kind of goes along into my next question is there a sufficient explanation as to why the 5-inch or 14-inch data should be excluded as outliers?
Not that I've seen provided in the record.
That concludes my questioning.
Thank you. EOE. Thank you. Attorney General. CIEC. And confirming that the company had waived costs for this panel. Thank you. All right, Attorney Wheel, do you need a moment to consider redirect?
No, we're all set.
Thank you. Then I appreciate your testimony, Mr. Nelson. You are excused until the late file hearing. So we are going to wrap here for the evening. So we will reconvene tomorrow at 10 a.m. On the company's rates and rate design panel, please. Thank you.